basically the manufacturing cost which was incurred by such a company in a certain financial year. So what is a manufacturing company? A manufacturing company basically is a company which buys some raw materials and basically converts that into finished products or into finished goods, which are then sold to wholesalers, which are sold to the final consumer. So that is the first thing you need to understand, that this particular account here is basically prepared by the manufacturing entities. And actually, we are saying manufacturing entities. These are those entities or basically companies which buy some raw materials, and basically convert them into finished goods, or basically into finished products. So mean that these particular companies here, the manufacturing companies, whatever they sell is basically what they have been able to manufacture internally. So they will buy some raw materials, they convert those particular raw materials into finished product, and basically this is now what they sell. Now, what we are saying is that at the end of the year, this particular company must prepare something called a manufacturing account. And the main objective of preparing this account is basically to determine what the production cost, or basically the manufacturing cost. So how much cost was incurred by this company in converting these particular raw materials into what? Into finished goods, or into finished what? Products. So that cost, we are referring to it as the production cost. The production cost, it can also be known as the manufacturing cost. It can also be known as the manufacturing what? Cost. And actually, in this case, we are saying for a manufacturing entity to be able to determine the production cost which was incurred in a certain financial year, so account which is called manufacturing account has to be prepared. So therefore, a manufacturing account, this one is prepared, is basically prepared to do what? To determine the production cost. The production cost, or basically the manufacturing cost, which was incurred in a certain financial year, or basically which was incurred in a certain what? In a certain period. So therefore, the main objective of this particular topic here is basically to know how the manufacturing account is prepared. But it's also important for you to note that other than manufacturing entities preparing this manufacturing account, the manufacturing entities also prepare the other financial statement, the normal financial statement, which include the statement of profit or loss, and also the statement of financial position. But even before these financial statements are prepared, first of all, a manufacturing entity will have to prepare what is known as the manufacturing account. So once the manufacturing account has been prepared, then that is the only time a manufacturing entity can be able to proceed and prepare the statement of profit or loss, and also the statement of financial position. So is there any difference in terms of how we prepare the statement of profit or loss, the statement of financial position of a manufacturing entity? No much difference. There is only a slight difference when it comes to the preparation of the statement of profit or loss, specifically when computing the cost of sales. Even before you look on how we prepare the manufacturing account, when computing the cost of sales, the cost of sales of a manufacturing entity, remember generally when computing this, we take the opening stock. The opening what? Stock. In other terms, we take the opening inventory. So, but now for these manufacturing entities, usually they have three types of inventory. They have three types of inventory. We have the inventory of raw materials. We have the inventory of the finished product or the finished goods. And also we have inventory of something called the work in progress. Maybe you're going to look on what is work in progress even before you look on how the manufacturing account is prepared. So here, when computing the cost of sales, we take the opening inventory of the finished goods. And then in this case, generally, we should add the purchases. But in this case, we are saying what the manufacturing entity sell is what they manufacture internally. So what we add here is not purchases, because manufacturing entity do not buy to sell, they produce to sell. So what we add here is the cost of the goods which were produced. The cost of the goods which were produced. And actually, we can only be able to determine this cost of the goods which were produced by first of all preparing the manufacturing account. So I want us to look on how we prepare this account. But even before you do that, maybe there are some few terms we need to define here. One is there's something called the prime cost. The prime cost. What is prime cost? Basically, prime cost. This is the total direct costs which are incurred, because it is important for you to note that this particular production cost, which are incurred by a manufacturing entity, this production cost can be generally classified into two. So we have the direct cost, and number two, we have the indirect cost. The indirect costs are also known as the factory overheads. They're also known as the factory overhead. So when talk about the direct cost, these are those particular costs which basically varies with the level, or basically which changes with the change in the level of production. Anytime the level of production changes, this particular cost will change. A good example is the cost of raw materials. So if the company is not producing any units, the company does not need to buy raw materials. If the company is producing 10,000 units, raw materials must be bought. If the company increases the number of units to be produced to 20,000, automatically the raw materials to be used will also do what? Increase. So the cost of raw materials is a direct cost. It always change with the change in the level of production. We also have other costs known as the direct labor cost, like the wages which are paid based on the time an employee has worked, not the salary, because salary we know they are fixed. Salaries do not change. So, but wages which are paid on the time worked, or maybe the number of units produced. So therefore, the production cost we are saying is generally classified into two: the direct cost, which are the costs which varies proportionately with the level of production, and then we have the indirect cost or the factory overhead. These are basically those particular costs which are fixed. They do not change. Even if the level of production changes, these costs do not change. A good example is something like rent. If a company is paying a rent of 2 million every month or every year, so whether the company produces or not, that rent has to be paid. So it's a fixed cost. It's an indirect cost. It is a factory overhead. So therefore, the production cost, the costs which are incurred in a production process, they are classified into two. Now, coming back to this, when talk about the prime cost basically is the total. This is the total of the direct costs. The total of the direct cost. So if you take the direct material cost, the direct labor expenses, plus any other direct expense, you get the prime cost. Then from there, we have something known as the work in progress. The work in progress. So basically, work in progress, abbreviated as WIP. This refers to those particular units which are, or maybe to those finished goods which are partially complete at the end of the year. Like, let's take a good example of a company which manufactures something like motor vehicles, or maybe a company which manufactures things like what? Motorbikes. Maybe there are those motor vehicles, there are those motorbikes which are partially complete when the year is coming to an end. Partially complete means that something needs to be done to them before they can be taken to the market. They are not partially complete. They cannot be taken to the market.
If you can hear me, then you respond with a yes. Good evening, Anne. Good evening, Aziz. Good evening, Sharon. Good evening, T. Good evening, VMM. And good evening, Walter. Can you hear me? You respond with a yes if you can hear me. Perfect. So we stopped at what we call taxation across the borders. And the last statement that we basically made, we talked about individuals that are basically affected by what we call double taxation. One of it, we say that these are citizens that basically work abroad, or one of the few people that are affected by double taxation, citizens working abroad. We have what we call the expatriate employees working in Kenya. We have sportsmen or professionals, sportsmen and entertainers that basically earn income from abroad. Then we have businesses that are carried partly in Kenya and partly outside Kenya. So then we get to what we call the objectives of double taxation agreements. What we call the objectives objectives of what we call double taxation agreements. Objectives of what we call the double taxation agreements. So what we call the objectives of what we call the double taxation agreement. So what do you think are the objectives of what we call double taxation agreements, where two countries engage into agreement for citizens probably working in those two particular countries? One of which is basically to attract investment, to say to attract investment. So basically, when you're taxed on both ends, will that be able to attract investment? Let's say, for example, there is the two countries, for example, Kenya and let's say China, and we do not have double taxation agreements. What happens? It basically implies that you're going to be taxed double. And in that scenario, do you think we'll be able to attract what we call investment? We will not be able to attract investment. So we say to attract what we call skilled manpower, to attract what we call skilled manpower. To basically attract what we call the skilled manpower as a second, to attract what we call the skilled manpower, then to protect citizens of the country, protect what we call citizens, we say of a country, we say from what we call from double taxation, to basically protect citizens of the country from what we call the double taxation, to protect what we call the citizens of the country, we say from double taxation. We can also say to facilitate, we say to facilitate what we call free movement, we say of labor, to facilitate what we call free movement of labor. In instances where an individual is taxed double, in cases where countries do not have what we call the double taxation agreement, people will not easily move altogether. Then say encourage citizens of the country, encourage what we call citizens, say of a country to look for jobs, for jobs abroad. So this definitely will encourage what we call the citizens of a country to basically look for jobs abroad because of these agreements. Together, team. If you're together, then you just give it a yes. If we are together, then we give it a yes. So what are some of the countries, VMM, switch off the video. What are the countries, some of the countries that Kenya basically have what we call a double taxation agreement with? What are some of the countries that Kenya basically have what we call the double taxation agreement? What are some of the countries that basically Kenya has what we call a double taxation agreement? For sure, United Kingdom, Kenya has what we call a double taxation agreement. We have India. We have what we call the East African Community, that is Uganda, Tanzania, Burundi, and Southern Sudan. We also have Sweden. These are some of the countries that basically Kenya has what we call a double taxation agreement. And the essence of those agreements, we talked about the objectives of those agreements on this particular. So I want to talk about what we call conditions to be met. Conditions to be met. We say to be met. We say in order to qualify, in order to basically qualify for what we call for double taxation relief. So we have what we call conditions to be met in order to qualify for what we call the double taxation relief. that in order to qualify for double taxation relief, the certain conditions that must basically be the certain conditions that we understand that must basically be met in order to qualify. What are these conditions that basically must be met in order to qualify for what we call double taxation relief? What are these conditions that must be met? So in order to qualify, tax must have been paid in other countries altogether. If you're Kenyan, the tax must have been paid in other countries. So the first one, we say the tax must have, we say, been paid. The tax must have been paid in that, we call it other country. The tax must have been paid in that other country on income. On income, we say subjected to what we call to double taxation. On that income that are basically subjected to double taxation, that the tax must have been paid to that other country, basically on that income that we understand is subjected to double taxation. Number two condition will basically say that double taxation relief, double taxation relief, we say should not exceed. So what we call the double taxation relief should not exceed what we call the tax payable in what we call in the home country. In the home country. But the double taxation relief should not exceed tax paid in the home country on income subjected to double taxation, on the income that we understand is subjected to double taxation. In most of the questions, you'll always find that the tax on other countries is lower, are we together? As compared to the same income subjected to taxation in Kenya. Together, team, we respond with a yes, if you're together. Are we together? So the third, there must be what you call the double taxation relief policy. There must be double taxation. There must be what you call the double taxation relief policies, say in the country. There must be what you call double taxation relief policy in the country. There must be what you call the double taxation relief policy, and we understand in the country. Then we say we have four that we call time limit. Time limit. Number four, we understand the time limit of making the claim, of making what you call the claim, of making claim. We say for a relief, time limit for making claim of relief is usually we understand 6 years since the tax payable, was paid in what's called, was payable in that other country, was payable in that other country in relation to income, in relation was 6 years since the tax payable was paid in other country, in relation, we say in relation to double taxation, in relation to what we call double taxation. in relation to what's called the double taxation. Those are conditions in order for one to qualify for what is called the double taxation relief. We respond with a yes. Together. We respond with a yes if you're together. All those conditions. We give it a yes if we are together. 𝐎𝐿𝐶𝐒, are we together? I'll say it on those conditions in order for one to qualify for double taxation relief. The tax must have been paid in that other country on income subjected to double taxation. There must be double taxation relief policy. And we basically said that the double taxation should not exceed the tax payable in the home country subjected to what we call the double taxation. So we get to what we call areas covered by double taxation agreement. Areas, we say covered by what we call double taxation. Areas that are basically covered by the double taxation agreements. Areas that we understand are basically covered by the double taxation agreement. And so one of the areas we basically say persons covered by the agreement. We understand the next is taxes covered by the agreement. Incomes that are affected by what we call the agreement. We have what we call terminations of agreement. Are we together? Terminations of agreement. So we can what we call one is persons covered by agreements. Persons that we know are covered by agreements. Number two, taxes. We understand covered by what we call agreements. Taxes are basically covered by agreement. Then number three, we have what's called incomes. Incomes, we understand affected by what we call the agreements. Incomes that we understand are affected by the agreement. You also have another area what's called terminations. Terminations of what we call agreements. Terminations of agreements. So then we have aspects of determination of residence of a taxpayer. Aspects of determining what we call residency of a taxpayer. Together, we respond with a yes, basically on areas that are basically covered by double taxation. Together, team. FJ, Lenovo, Mary, and the rest of the class. Tuko pamoja. If you're together, then we respond with a yes. So then if you're together, then give me a yes. So then we go to forms of double taxation relief agreements. What we call forms. Forms of what we call double taxation agreements. Forms of what we call the double taxation agreements. What we call the forms of double taxation agreement. One of the first form, we have it as unilateral. We have the first form, what we call unilateral relief. So when you say unilateral relief, what do you basically mean? Unilateral, before you get to bilateral, what do you basically mean by unilateral relief? Unilateral relief. I hope Miriam is in class. I hope Miriam is in class. And I hope Chengo is also in class. Perfect. And I hope Chengo is also in class. Yes, perfect. And I hope Gilbert is also in class. I hope Elvis is also in class. I hope Elvis is also in class. Perfect. Our representative, Sheila, I hope she's also in. So when you talk about unilateral relief, what do you basically mean by unilateral relief? unilateral relief. When you say unilateral relief, we say this is where we say that the government, this is where the government, we say that this is where the government decide to grant, say decide to grant what they call relief, decide to basically grant relief to its citizens, working abroad, decides to grant relief to its citizens working abroad who are subjected, we say who are subjected to what they call double taxation, who are basically subjected to what's called double taxation, without considering. Unilateral touches on one aspect. We say without considering. We understand that without considering whether other governments grant what they call their citizens, working in the country, double tax relief. And that is simple. What are we trying to say? That when you talk about unilateral, you basically grant to your citizens working abroad, you grant them relief without considering that the expatriates are granted relief by their countries altogether. That is basically what's called unilateral relief. Together, we respond with a yes. We respond with a yes if you're together. So then we go to bilateral. What they call the bilateral reliefs. So what is bilateral relief? What they call the bilateral relief. So what is the bilateral relief? What is a bilateral relief? When you say bilateral relief, what do you basically mean by the word bilateral relief? Somebody try. If we understand this, then this should be simple. So who can give us this? If you understand the unilateral, then bilateral should be very simple. So what is bilateral? So bilateral, countries basically considered. Bi means two, not more. Bi basically means two countries. Mary, when you talk about bi, basically means two countries. Are we together? They are in agreement. Not only one country is in agreement to grant its citizens, both parties are basically involved. And that is to say, this is where, this is where we say two, this is where two or more countries, but specifically by should be two or more countries negotiate, and say conclude, negotiate and conclude what they call the double tax relief. Negotiates and conclude what's called the double tax relief, the double tax relief agreement, double tax relief agreements to say where the citizens, where we say the citizens, where the citizens, where the citizens, where the citizens working in these countries, working in these countries are granted what we call the double taxation relief, where citizens working in these countries are basically granted relief. So basically say, even when you say more countries, so more countries could have Kenya, we could have Kenya and maybe China, we can have Uganda and Kenya, but they're coming in agreement together, where those personnel from the country working in both countries are basically granted what they call the double taxation relief. On the unilateral, what you say that if we are talking about unilateral, we grant this relief to personnel, basically Kenyans working abroad, but you don't consider whether those other countries are providing relief to their people together. So we go to the methods of determining double taxation relief. So we go to the methods, we call it methods of what we call of determining what we call the double taxation relief. So methods of determining what we call the double taxation relief. What are the methods that we basically have to determine what we call the double taxation relief? So there are basically two methods. We have the exemptions method, and then we have what we call the credit method. So we have number one, we call it exemption. We call it the exemption method. And number two, we call it the credit. We call it the credit method. So we have what we call the exemption method, and then we have what we call the credit method. So we have what we call the exemption method, and we basically have what we call the exemption method. We have what we call the credit method, and then we have what we call the exemption method. I want to start with the exemption method. To exempt, what does it mean to exempt? To exempt, what is exemption? When you say to exempt, not charge tax, perfect, Mary. So we have the first method, and we're calling it exemption. We are calling it the exemption method. We are basically calling it the exemption method. So the first method, we call it the exemption method. So we're saying in this, we say income. In this, we basically say that the income, and this the income, in this the income, say and abroad, and we say affected, and affected by what we call by the double taxation, and affected by what we call the double taxation, we say is not subjected to what we call tax. So basically we're saying that the income that is earned abroad and affected by what we call the double taxation, the country will not basically now subject it to tax in the home country, to tax in what we call the home country. Will not subject it to tax in the home country, as long as, we say, as long as the tax was paid in what we call in the source, as long as the tax was paid in the source country, as long as the tax was paid in the source country, as long as the tax was paid. So say the country, source country is country, where the income we say was generated. So source country is the country where the income was basically generated. The source country is basically the country where the income was generated, where the income was basically generated together, where the income was generated. All of us are we together? I want to pose a question. If you're together. Perfect, if you're there. So the question is altogether. I believe there's much closure in terms of now you understand what happens altogether. What happens if you have maybe family members abroad altogether? When you have family members abroad, are we together? When you have what you call a family members abroad, are we together? I'm moving. When you have what you call family members abroad, are we together? And the questions pertaining to what you call tax, how do you go about it together? In cases where there have been, how would you go about it practically? In case, for example, we have what you call an exemption clause altogether, but they have a PIN. What are you going to do? When you look at two countries, you have what you call an exemption clause. What are you going to do in scenarios where we have what you call an exemption clause? But they still have a PIN. So on that PIN, what are you going to file on that PIN? On that PIN, there's not an income that was generated in Kenya. The whole of their income was basically generated abroad, but we have in scenarios where we have exemption clause. With that PIN, what are you supposed to do with that PIN in terms of now filing taxes? So what are you going to do to that PIN? That is the question. What are you going to do to that PIN? We respond with a yes. What are you basically going to do with that PIN? Kindly, what are we going to do with that PIN? So basically, it's a exemption altogether. Exemption is basically exemption. You ask for a refund. You ask for a refund. Why should you be refunded? And we have what we call exemption clause. I want to expound on the exemption clause. We are basically saying that as long as you are paid, you are a citizen. Yes. Yes, perfect. With supporting exemption certificates together, with supporting exemption certificates together. In that case, what are you going to file? What are you going to file? I know practically there are a few areas of application and a number of things. Practically, not many people make this disclosure. Is that true? Practically, not many people make this disclosure. Is it true? When it gets to this area, how do you file, for example, for those brothers who are not here? Yes, they definitely file nil altogether. But again, you need to provide maybe along the way, you need to provide those supporting documents altogether, especially when we have what we call exemptions altogether. Those supporting documents implying that there is what we call exemptions between those two countries. Then you have what we call the credit method. The credit method, we have what we call the credit method. So on the credit method, this is where a majority of the questions basically come. When you have the credit method, this is where a majority of the question comes. So we say in this case, we say that the tax paid, basically in this case, the tax paid in that other country, the tax that is basically paid in that other country. So what we call the source country, stroke the source country, on income, subjected, on income, we understand subjected to double taxation, on income that is basically subjected to double taxation, on income that we understand is subjected to double taxation, is granted, we'll say is granted as relief in relation to tax payable, on relation to tax payable in what call in the home country. We say on income subject to what we call double taxation. Taxation. So I just want to remind us on something. We say conditions that have to be met. What did I say about condition 2? Conditions that must be met in order to be granted what we call the double taxation. In order to be granted what we call double taxation. I think it was condition 2. That was condition 2. What did I say on that condition 2? That the tax that you're basically paying abroad should be less than the tax that you're paying in the home country, 𝐻𝐿𝐶. So that tax that you're paying in the source country, you are basically granted. It is always what we call the lower. It is always what we call the law. Together, team. That's why you say that the tax that you basically paid abroad will be granted as what we call relief. It will be granted as a tax credit. We'll respond with a yes if you're together. Will be granted as a relief. Basically, with our condition number 2. Basically, condition number 2. We'll respond with a yes if it's here. Subject to condition 2. Perfect. So I want to ask to determination. Now then we get to question, determination. Determination. We'll call it determination. Determination of tax. Determination. What we call determination of what we call tax of double tax. What we call the double tax relief. Determination of what we call the double tax relief in Kenya. Determination of what we call the double tax relief in Kenya. And what we call determination of what we call actual tax, of what we call actual tax payable, and what we call the actual tax payable by what we call persons, we say affected, by persons that we say are affected by what we call by double taxation. By double taxation. We understand those persons that are affected. Are we together? Do we understand on those persons that are basically affected by what we call the double taxation? Persons that we say are affected by what we call the double taxation. We know the persons that are affected by the double taxation together. Is there a question on those who are affected by double taxation? Or that was exhausted perfectly well? Was that exhausted perfectly well? On persons that we understand are affected by what's called the double taxation. Perfect. So how do we determine, based now on the credit method, double taxation relief and the actual tax payable on the persons that are affected by what we call the double taxation relief? Number one, the double taxation relief is comparison altogether. The tax that was basically paid on the source country, that is basically income that was earned abroad, Then you put that income in terms of the Kenyan system and you get the tax that is payable. Are we together? You get the tax that is payable. Remember, under the intermediate, we basically say that for resident, their employment or for business that are partly operated in Kenya and partly operated outside Kenya, we say that both incomes are basically taxed in Kenya. And the big question is that, is this now double taxation? And how do we sort those issues? Does this basically provide solution to those issues that we talked about on intermediate? Does it provide solution? If you remember, for those that I taught on the intermediate, does this provide solutions to those? Does that provide solution to that? Because the question is, if you say that you'll be taxed here and taxed that on the other side, what if you're taxed on the other side? How do we go about it? Are we together? But first on that determination of the of double taxation relief, we understand that the double taxation relief is basically the tax that was paid on the source country. That is the tax that is paid in abroad, particularly. Which in our case, we understand that if you subject that income that was earned abroad, in terms of taxation in Kenya, the tax that is paid in Kenya should be higher. Are we together? Because the tax that was paid outside the country should be lower on the condition. Then how now do we determine the tax payable for these persons that are affected by the double taxation relief? So we understand that the double taxation relief, once we get it, we compare the tax that was basically paid abroad and the tax that was paid in Kenya. And we understand that the tax that is basically paid abroad is lower. We are going to use that tax that was paid abroad as what we call the tax credits. Together, team, we are going to use it as the tax credit. You give me a yes if we are together. You give me a yes if we are together. You give me a yes if we are together. And we basically said on these classes that the most important thing is to understand the concept. It's not a question. The most important thing is the concept behind what you're about to do. Are we together? So once we get the concept is the most important thing that we need to focus on. Once we get the concept right, we don't have to be perfect. We can go step by step. You can miss one step altogether. Prayer break. Can we take it now, or we give Aziz, you can allow us to finish this? Or class, are we in agreement that we take a break? Are we in agreement that all of us will take a break? Can we? So Aziz, you okay? You'll get us back. We also don't want to leave Aziz. So what we do, we grant the break to, we respect his time for prayer, and then we come back. So we give our 10 minutes. When you come by 7:01, yes, it's okay. Ouko, you're making the class lively. It's okay. So we can take our break so that we also respect his time for prayer. The double tax relief is basically the law. One is tax payable. We call it tax payable. We say in Kenya, tax payable in Kenya on income. We say subject on incomes that we basically say subject to double, subject to what we call double taxation. On incomes that we understand are basically subject to what we call the double taxation. On incomes that we say are subject to double taxation. So you compare with the tax on what we call on the source country, tax on basically what we call the source country. We say on income, we say subject to what we call double taxation. On income that we understand are subject to what we call double taxation together. So which on the condition we basically know that the relief will be the tax that is from the source. So we say the steps in determining, we say in determining what we call the double taxation, steps in determining what we call the double taxation relief, and what we say, and what we call the actual tax payable. So the steps that we use to determine the double taxation relief and actual tax payable by the taxpayer. And the actual tax, we say, payable by the taxpayer. And the actual tax that we understand is payable. So I want us to be very keen on those steps. I want us to be very keen on these steps. I want us to be very keen on these steps. I want us to be very keen on these steps. So look at those steps. I want us to try and finish those steps by, in the next 10 minutes, we finish those steps. So the first step, number one step, we say that determine the taxable employment. Determine what we call the taxable employment. Income, we say earned in Kenya. That is number one. Determine what we call the taxable employment income earned in Kenya. So number two, we say determine what we call total tax payable, on income and in Kenya. So when you say the total tax payable, what do you basically mean? When you say the total tax payable, what do you basically mean? That is employment plus investment income. That is what we call the employment plus what we call the investment income. So we have the employment plus what we call the investment income, employment plus what we call the investment income. Together, team, employment plus the investment income. So then with determination of tax payable, number three, we call it determination of what we call tax payable to income of tax payable of income, we say earned in Kenya, and what we call the outside Kenya. So determination of tax payable of income, this one was basically in Kenya. But point three, we also include what we call the income earned outside Kenya. Together, team, income that is earned outside Kenya. We respond with a yes if you're together. So income that is earned in Kenya plus income that is basically earned outside Kenya. Together, income that we know is earned in Kenya and income that is earned outside Kenya. All of us tuko pamoja. So number one was employment income. Number two, you include employment plus investment. Then number three, we also include now the income that is earned outside Kenya. Together, Robert, Norbert, and Gilbert Mitich. Together, if you're together, we respond with a yes. So we have this was taxable income, so taxable income. This was determination of taxable income of income earned in Kenya and income earned in Kenya and outside Kenya. Number two, determination of tax payable on income earned in Kenya and outside Kenya. The number four, we say that determination of total tax, we say determination of what we call of total tax on what we call on total income, total tax on what we call total income, and in Kenya, and in Kenya, and in Kenya. So this is the taxable income, but now you determine the tax altogether. This is the taxable income. Remember, this is taxable. That's why I changed taxable income. After taxable income, you determine what you call the total tax on income earned in Kenya, and what you call outside Kenya, on income earned in Kenya, and that is earned outside Kenya. So say that is determination of total tax on total income. Determination of what we call total tax, we'll say on total tax on what we call on total income. So after determining what we call the taxable income, that is both in Kenya and outside Kenya, so you determine the tax that is payable on the total income. Then five, determination, we get determination, we say determination of tax income, and in Kenya, determination of what we call the tax income and in Kenya. So I want to ask a question. The difference between this and this, what does it give us? The difference between number 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? So 4, we basically say that is the tax payable for income that is basically paid for income earned in Kenya. Yes, it's a tax on income abroad altogether, or the relief altogether. So that is the tax that is charged on abroad, which is the relief. That is the tax that is charged abroad, or what you call the relief altogether. So that determination. Then 6, we say this. We say it determination. We say determination of tax. We say on income. Determination of what's called tax on income. And outside Kenya. Are we together? Outside Kenya. Determination of tax on income outside Kenya. So tax on income, we say, and outside Kenya, tax on the income and outside Kenya is basically equals to what we call tax on what we call total income, tax on what we call total income, and we say in Kenya, and what we call outside Kenya. So tax on income and in Kenya and outside Kenya, minus what we call tax on income, we say, and in Kenya. And that is basically difference. We understand difference between 4 and 5. So that is the difference between 4 and 5 together. So the difference between 4 and 5 gives us the tax on income and outside Kenya, which is the relief. Tuko pamoja. So that is the difference between 0.4 and 5 together. And that is what we basically call the relief. Chengo tuko pamoja, Lenovo. If you're together, you give me yes. If we are together, you give me a yes. Kindly. I hope we are together. Perfect, Chengo. We are about to be done. Then we pick a question. Thank you, Lenovo. Then 7, we say that we call it determination. Determination of what we call of double taxation. We call it relief. The determination of what we call the double taxation relief. Determination of the double taxation relief. Determination of the double taxation relief, which is taken, which we say is taken, we say as the lower, which is taken as the lower of. So you compare two things, which is basically taken as the lower of. Tax paid on source country, tax paid on what you call on the source country, on income. On income, we understand that subjected to double taxation. So say tax on income on the source country, tax paid on source country, on the income subjected to double taxation, on the income subjected to double taxation. Then B or 2, we call it tax payable. What do you call the tax payable? In Kenya, tax payable in Kenya on income. On income, we understand subjected to what we call double taxation. And we always understand that it should be the law because on the condition, if you compare the tax that is paid on the source country and the one that is paid in Kenya, this one is always the law, and that is what we call the relief altogether. Then say 8, that is 8, we call it determination of actual tax. We call it actual tax payable. Determination of what we call the actual tax payable. Determination of what we call the actual tax payable. Determination. We call it determination of what we call the actual tax payable, or the actual tax payable in Kenya. Determination of the actual tax payable in Kenya is, we say determined as follows. Is basically determined as follows. So say actual tax payable in Kenya. So the actual tax payable in Kenya is usually equals to, that is the tax on what we call on total income. The tax on total income. Total income is from abroad and Kenya. That is from abroad in Kenya. That is basically from abroad in Kenya, minus what we call the tax credits. Minus what we call the tax credits. Minus the tax credits. Minus the tax credit. And I open the brackets just to get those tax credits as I open the bracket. One of the tax credits is pay as you earn. We have insurance relief. We have personal relief, and and what's called double taxation relief, and what's called the double taxation relief. So again, that tax, if you compare the tax that is paid on income from abroad, the tax that is paid in Kenya, and the tax that is paid from the source country, we say the law, which is basically the tax that is paid from the source country, we need to less it. So that we introduce another tax credit, which is called the double taxation relief. Is that understood as we pick on a question? I want us to pick on a question. Is there any question before I get to, before we start on actual testing on that? Is that understood? Tumeelewana. Tuko sawa. Are we together? Perfect. Chengo tuko sawa. VMM tuko sawa. Tax credit. No, I'm saying, Aziz, why do you say pay is not a tax credit or a setup? Why do you say it's not a tax credit? Why do you say it's not? Why do you say the tax pay is not a tax credit? Yes, on individual. Say on individual. Are we together? So we basically, when you say on individual, we understand that as a tax credit. Most of these questions basically touch on individual. As is most questions, particularly on taxation across the borders, most questions are formulated for individual. That's why we include it there. Is that noted as is? So I want us to pick the question. I think the question that was the last time that was in December. Check December question 5. Is Ambucha in class today? The last time, the latest was set in December 2024. Check for me December 2024, question 5. December 2024, question 5. Check December 2024, question 5. Companies who can have installment tax. Uko, installment tax. Installment tax. Uko, companies, installment tax. They basically have the installment tax. Perfect. So I've said December 2024. If you look at the latest question, I normally start with those questions. Latest question. Do you have that question in question 5C? Nimeshukuru. Thank you so much. So all of us, let's get that question 5. All of us, let's get that question 5. All of us, we get that question 5. Question 5, we say C. Yes, question 5C. So we call it deck 2024, question 5C. Kama tuko hapo tubonyeze yes. If we are there, then we respond with a yes. If we are there, then we respond with a yes. Allow me to open that question. Just a minute. So we are being told, Tamala Nyambura is a resident of Kenya, and you're being told that during the year ended 31st December 2023, she received the following income. She received what we call the following income. So number one is from employment in Kenya. The figure was 720. Then we have from employment in Zambia. The figure was shillings. The figure was shillings. The figure was shillings. We have it as shillings by 40. When you say net of 78 paid as tax, net of 78, that was basically paid as tax. So net, what does it mean when you say net? When you say net, what does it basically mean? When you say net, what does it mean? You add to get the gross profit as is to gain tax. We were talking about capital. That was on the capital gain tax. Capital gain tax, that is CGT. So we basically say that when you talk about the CGT, these are taxes on transfer of property. And basically the properties in question was what we call the land and building. The property in question was basically land and what we call building, land and building. That is where we stopped. And you say that CGT, the rate of CGT, that is the capital gain tax, is currently, we say currently, it is 15. It is what we call 15% of what we call of the capital gain. That currently it is 15% of the capital gain. We say that initially these changes were effected. When you talk about these changes were effected on January 2020, January 2023. These changes were effected in January, that is 2023 altogether. Initially, the capital gain tax was basically 5% of the capital gain, Are we together? If we are together, we respond with a yes. Kama tuko pamoja, then we respond with a yes. Perfect. How do you get capital gain? We say that capital gain is equal to what we call transfer value, what we call the transfer value, minus what we call adjusted cost, minus the adjusted, what we call the adjusted cost. So capital gain, we say is the transfer value minus what we call the adjusted cost. Transfer value minus the adjusted cost. Is the camera clear? Is the sound audible? Is the camera clear and is the sound audible? We respond with a yes if the camera is clear and the sound is very audible. Are you able to see the board? Is everything okay? We respond with a yes. Today we do not want anything to get into our way. Is everything okay? Perfect, if everything is okay. Asante. So how do you get transfer value? How do you get the transfer value? How do you get the transfer value? We say that how do you get the transfer value? Selling price of the property, what they call the selling price of the property, and you say minus what they call cost incurred while selling, minus the cost incurred while selling, minus the cost incurred while selling. Tuko pamoja. Minus the cost that I incurred while selling, minus the cost that you incur while selling. What are the costs that you incur while selling? We have what's called advertisement cost. Advertisement, what you have as the advertisement cost. We have what's called the brokerage fee, etc. Advertisement cost, brokerage fee, etc. Together, team. If we are together, we respond with a yes. etc. Together. If we are together, we respond with a yes. Then we proceed to what we call adjusted cost. Adjusted cost. How do you get the adjusted cost? How do you get the adjusted cost, Chunguli? How do you get our adjusted cost? How do you get our adjusted cost? So we have what we call the purchase cost. Purchase cost plus enhancement, so construction plus enhancement cost, so what we call the construction enhancement plus the construction. They say plus cost that are incurred that are you able to see where I'm writing? You can see where I'm writing, costs that are incurred. Are you able to see what I'm writing? Perfect. Costs that are incurred during purchase, stock after purchasing. So what are these costs that are incurred when we are purchasing, during purchasing, or after purchasing? What are these costs that are incurred during stock after purchasing? What are these costs that are basically incurred during stock after purchasing? We have the legal cost, we have valuation, we have the valuation cost. Those are costs that are incurred after purchasing, during purchasing. But again, you can also have legal costs that emanate after you purchase. Let's say, for example, somebody lays a claim on that property and is legally wrong, and you won the case. That case will be part of adjusted cost. And you say minus continuation, minus what you call investment allowances, minus investment allowances. And then this is the case for what you call for the building. And that investment allowance will definitely be IBD. That investment allowance, say that purchase cost plus enhancement cost of construction, plus the costs that are incurred, costs that are incurred during purchase, stock after purchasing, then we left what's called investment allowance. And to be precise, this is capital investment on the building. Remember that land does not qualify for any capital allowance. Are we together? We respond with a yes if we are together. Then an NB. When do we remit the capital gain tax? When should we remit what's called the capital gain tax? When should we remit what's called the capital gain tax? When should we remit what's called the capital gain tax? We remit it by 20th. We say 20th of the following, what we call 20th of the following month. We say 20th of the following month. So if you transfer the property, a simple question, if you transfer the property, for example, you transferred a property, for example, in the month of May, when should you remit that capital gain tax? If you transfer the property in the month of May, when should you remit that capital gain tax? When should you remit that capital gain tax? When should you remit the capital gain tax? When should you remit the capital gain tax? We say that it's remitted by 20th of the following month. That is the 20th of June, Asante Chunguli. That should be the 20th of June. I want to come up with illustrations, basically on two concepts that we've learned. Illustration on the two concepts that we've done. Illustration on TOT. I want us to have illustration on TOT, illustration on the TOT, and what we call the capital gain tax, and the capital gain tax. When you talk about TOT, tumesema TOT is what we call the turnover tax. We call it the turnover tax. We call it the turnover tax. So the last time this question was basically set, this question was set in the August. We'll say August 2023. Check question 4. Open your past papers. Somebody send the past paper in the group. August 2023, question 4. That is on TOT, illustration. Do you have the link to the past papers? So the last time the TOT was set was August 2023, that is question 4. Question 4. Do you have the link to the papers? Do you have the past papers? Do you have? Let me send this past paper link. Is there anybody with a link to the past paper? The link to the past papers. Link to the past paper. Somebody to forward. If you have the link, whoever has the link to the past papers, link to the past papers. Let me see. The link to the past paper. Has somebody gotten it? Has somebody gotten it? If you've gotten it, send it to the group kindly. Kama kuna mtu akona hiyo link, atume kwa group. Send it to Google. Send the link to the past papers to the group. For others, send the link to the past paper for others. Send it very fast. Once you're done, you respond with yes. Chunguli very fast so that we don't take much time. Perfect. That link is there. So open that link. Open the link. That is CPA. So 2023. We move to August. We move to August. So we open that. So question 40. So once you have it, you respond with a yes. Question 40. Do we have the first paper? Perfect. If we have it, we'll respond with a yes. If we have it, then we respond with a yes. Tafadhali. Have we gotten it? Perfect, if we have it. So we told Bright Traders is a small business in the 𝐎𝐿 sector. Bright Business is a small business in the 𝐎𝐿 sector. The following information was presented to you for the year ended 31st December 2022. That the following information was basically presented to you as an accountant for the year ended 31st December 2022. So the first information is information on sales. And you're being told that from January to April, the sales was basically 1.8. The sales was 1.8. Then you're given from May, we're being told that from May, we have May to August. May to August, the sales was 2.2. From May to August, the sales was 2.2. Then finally, we're being told that September to December, the sales was basically 3.2 together. If you're together in that, we respond with a yes. The sales was a figure of 3.2, this was 2.2, and this was 1.8. So then the government tells us that the business purchased, we are being told that the business purchased goods 4 times, that the business purchased goods 4 times during the year. The first purchase was basically made in January, and the figure is 600,000. Are you able to see that figure? The figure is 600,000. The first purchase that was made was done in January, and the figure is 600,000. The second purchase was basically made in May, and the figure was 800,000. And the figure was 800,000. Then the third purchase was basically made in September, and the figure was 200,000. Then you're being told that December, which is the last purchase that was made in December, the figure was 500,000. The figure was basically 500,000. So you're being told that expenses incurred during the year, apart from the purchases, there were expenses. So being told that salaries and wages for the whole year total to a figure of 260. Then you're being told that electricity for the whole year, that amounted to a figure of 180,000. Then you have what we call legal expenses, amounted to 100,000. Then you're being told that stationery amounted to 60,000. And then you have what we call water expenses. The figure was 28,000. That water expenses, the figure was 28,000. Then finally, the rent expenses, the figure was 280. Can we respond with a yes if the figures can be seen by all of us? Can the figures be seen by all of us? Perfect. Thank you so much. So the last information, you're being told that the proprietor, when you're told that the proprietor of Bright Limited, that is the owner of the Bright Limited, is not conversant, that this person is not conversant with turnover tax requirement, that this individual is basically not conversant with what you call turnover tax requirement, is not conversant with what you call turnover tax requirement, and has approached you to advise him on whether the business is liable, for turnover tax, so that the amount payable for the year ended 31st, the amount liable for the year ended 31st December 2022. So the two aspects here, the two things. You're supposed to advise the owner of Bright Traders whether the business is liable for TOT, whether the business is liable to TOT, how much TOT should be paid, how much TOT should be paid. So we answer the first thing. Are they liable for TOT? That's the first question. Because you're getting consultants. Is this business liable for TOT? That is the first question. Is the business liable for TOT? That is the first thing. Is the business a week of Ryan and the rest of the team? Is the business liable for TOT? That is the first question. Why is it liable for TOT? Why is it liable for TOT? Why do you say it's liable for TOT? Why do you say that it's liable for TOT? Why do you say it's liable for TOT? Why is it liable, Joy Wang? These are the first questions. Why is it liable for TOT? Why do you say this business is basically liable for TOT? Why do you say it's liable for TOT? So I want to bring an information that is good based on this. But remember, these changes, are we together? These changes were not effected at that time. Before that, was effected in 2023. As of 2022, TOT was 1 million to 50 million. 1 million to 50 million. Before the changes were effected, at that time, TOT was basically business was 1 million to 50 million. Are we together? 1 million to 50 million. Together, 1 million to 50 million. 1 million to 50 million. Together, 1 million to 50 million. This 1 million to 5 million is after changes that were made in 2023. But before that, it was 1 million to 50 million. So we get to the sales. If you look at sales, that is between January to April, the figure is 1.8. 1.8. We have May to August. The figure is 2.2. And finally, we have September. Today, the figure is 3.2. So what is the total sales at that time? What is the total sales if you add it? What at that time? What is the total sales? If you add that, what is the total sales? So the total sales should be 7.2. And when you look at 7.2, 7.2 at that time falls between 1 million to 50 million. 1 million to 50 million. So yes, the business is liable for TOT because before the changes, TOT was basically between 1 million to 50 million. 1 million to 50 million. 1 million to 50 million to 50 million. Is that okay? That was basically 1 million to 50 million. 1 million to 50 million. That was basically 1 million to 50 million. What was the rate of TOT as at that time? What was the rate of TOT as at that time? In order for us to know that amount of tax that was liable. As at 2022, the rate of TOT was 1% of what you call the gross turnover. As at 2022, the rate was basically 1% of the gross turnover. 1% of what you call the gross turnover. 1% of the gross turnover. 1% of the gross turnover. But based on the changes currently, we are using 3%. If you have the questions attached on 2024, those ones should be 3%. But at that time, TOT was 1%. So what was the TOT is liable that it was liable? 1% times 7.2. How much was it liable for? Remember, TOT is on what you call the gross turnover. That's why I don't touch on the expenses. Why don't I touch on expenses? Because TOT is basically charged on the gross turnover. So how much TOT was he liable for? 1% as of that time. How much TOT was he liable? Give me the figure. How much TOT? Perfect. That should be, great students, that should be 72,000. That is how much TOT. But presently, if you have questions that touch in 2024, we know that the rate is 3%. 3%. The rate is basically, yes, join. At that time, the changes had not been made in the finance bill. So at that time, it was 1%, 1%. And you say gross turnover. Somebody may ask, why are you, Molimo, not touching on the expense? TOT is based on what? On the sales, on the gross sales, and not the net sales. To get a team. So that is done for the TOT. Is that question understood? Or watu wameelewa hiyo? Watu wameelewa hiyo? Perfect. Is there anybody who's floating? So I want to pick the next question on now capital gain tax. On capital gain tax. The second is on capital gain tax. Capital gain tax. This is on capital gain tax. Capital gain tax. Capital gain tax. Capital gain tax. So the last time this question was basically said, that was when changes were effected. This is April 2023. April 2023. That should be around question 4. Question 4. This question just came when changes were effected in January. So open that capital gain tax. So we open that capital gain tax, April 2020. It's question 5, I think question 5. So April 2023, question 5. April 2023, question 5. Are we there? Question 5D. Question 5D. Are we on it? On capital gain tax. Are we on it? If you're on it, respond with a yes. Perfect. So we can move on it. So being told that Share Abdallah, we are being told that Share Abdallah disposed a property. Share Abdallah disposed a property in September 2022. The Share Abdallah disposed a property in September 2022 for shillings 18,500,000. What does 18,500,000 constitute? What does the figure 18,500,000 constitute? You're being told that Share Abdallah disposed of property for shillings 18,500,000. What does 18,500,000 constitute? What does it constitute? 18,500,000. What does it constitute? The figure of 18 million, that constitutes a transfer value, because that's what? That's the selling price. So I'm being told that the property consists of a piece of land. The property consists of a piece of land which he had bought in 2007 for shillings 1.3 million. What is 1.3 million, particularly in that question? 1.3 million in a represent name. What does 1.3 million represent? So 1.3 million represents an adjusted cost. And to be precise, that is what? That is the purchase cost of the property in question. So then we're being told that he incurred legal cost. We're being told that he had incurred legal cost of 650,000 on transfer. So the legal cost that was incurred of 650, what does it constitute? That legal cost. What does it constitute? The legal cost of 650. It also constitutes what? The adjusted cost. The 650 constitutes the adjusted cost. The 650 constitutes what's called the adjusted cost. Then you're being told that on transfer, in addition to stamp duty of shillings 13,000. My question is, what does the stamp duty constitute? What does the stamp duty constitute in this particular question? What does the stamp duty constitute? The stamp duty also constitutes what we call adjusted cost, because these are costs that were incurred when purchasing the property. Then you're being told that he put up an hotel, he put up an hotel building at a cost of 9.8 million. How would you treat the 9.8 million for an hotel that was put up? How would you treat that? The 9.8 million for an hotel that was put up. How would you treat that 9.8 million for an hotel that was put up? Joy, how are we going to treat the 9.8 million for that hotel that was put up? How are we going to treat it? That will constitute enhancement cost. So you're in a whole on adjusted cost. The 9.8 million for an hotel, that is an enhancement cost. So that definitely constitutes what we call an adjusted cost. Mambo iko sawa? Is everything okay? That constitutes what we call an adjusted cost. Are we together? If we're together, we respond with a yes. So then we're being told, and was completed in 2008. Then you're being told that a local politician had a claim on the property, in 2011. That just like normal politicians, when they see that you have a very good business, they want to take it over. So a local politician, we're being told, laid a claim on the building in the year 2011. Sheikh Abdallah filed a suit against her and won and spent legal charges of 3,450,000 on the case. So when the politician laid claim, Sheikh Abdallah went to the court, and you're being told he used a legal charge amounting to 3,450,000 and won the cost. How are you going to treat those legal costs that were incurred by Sheikh Abdallah? How are we going to treat those legal costs that were basically incurred by Sheikh Abdallah? How are we going to treat those legal costs? Are they going to constitute adjusted costs? Are they going to constitute adjusted costs? Are they going to constitute an adjusted cost? Yes, they're going to constitute the adjusted cost. Then you're being told the following costs were incurred to dispose the property. The following costs were incurred to dispose of the property. Number one, you're being told that valuation cost, the figure is 247,000. We have advertisement 52. Then you have commission to buyer seeking agents. How are we going to treat those costs that were incurred during selling? Where are they going to? We are going to less them. We are going to less them on the selling price altogether. We are going to less them on the selling price. We are going to less them on the selling price. Tuko sawa. We are going to less them on the selling price. Then lastly, we're being told that during the existence of the hotel, the building had been allowed an investment deduction amounting to 740,000. Amounting to 740,000. How are we going to treat that investment deduction? That during the existence of the hotel in question, that they had been allowed an investment allowance of 740,000. How are we going to treat the 740,000? To treat the 740,000, it's going to constitute part of adjusted cost, but we less it from the purchase cost. Yes, less from the adjusted cost. So then you're being told that the capital gain tax rate during the year was 5%. So the examiner is very clear. As at that time, capital gain had changed in January. Remember that was 2023 April. But the examiner set a question that touches on September 2022. So you must remember at that time, the rate was 5%. And that's why the examiner was very clear, because he knew the students would use 15%. So the first question, capital gain tax payable by Sheikh Abdallah on the disposal of property. Can we proceed with the question? Ama kuna swali? Can we proceed with the question? Ama kuna swali? Is the question clear? Can we proceed with the question? Ama kuna swali? Is the question clear? Ama kuna swali? Can we proceed? Perfect. So we say Sheikh Abdallah, Sheikh Abdallah, capital gain tax, we say for September 2022. For September 2022. We have this and this. So we have what you call we have selling price. What is the selling price of the property? What is the selling price of the property? The property was basically sold at 18. Give me the figure. 18,500,000. That was the value that the property was sold. 18,500,000. So then we say that with less incidental cost, we say incurred while selling. Less the incidental cost incurred while selling. So when we look at those incidental costs, we have what we call valuation cost. To call valuation. How much was the valuation cost? Monepatia. How much was the valuation cost? How much was the valuation cost? How much was the valuation cost? Valuation cost ngapi? 247. We have the valuation cost to be 247. Another incidental cost was advertisement. How much was advertisement? Advertisement ngapi? Give me the advertisement. Advertisement ngapi? Advertisement ngapi? Advertisement should be 52. Then you have what you call buyers seeking for me, what they call the buyers, commission to buyer seeking agents. Commission to what you call buyer seeking agents. Commission to the buyer seeking agents. How much was that commission? How much was that commission to the buyer seeking agents? How much was that commission to the buyer seeking agent? How much was that commission to the buyer seeking agent? That was 1 million. We have a figure of 1,850,000 together. So we have that figure that we need to less. So what is the total figure? I hope you have your class. When you come to a calculation class, lazima ubebe calculator. Lazima ubebe calculator. What is that? That we need to less. So we have 22,149,2 million. So then this transfer value now get value. This provides us with the transfer value. Transfer value when it's less those incidental costs that I incurred while selling. The transfer value. What is the transfer value? So the transfer value is a figure of 3,051,000. So then you go to what we call less adjusted. We have less adjusted cost. So the first adjusted cost, we have what we call the purchase cost. The purchase cost. How much is the purchase? Give me the purchase cost for the land. Purchase cost for the land. Purchase cost. So then you have what we call enhancement. Before the enhancement, we also before legal cost incurred. So during purchase, how much was the legal cost during purchase? How much was the legal cost? How much was the legal cost during purchase? The legal cost 60, 50. We have the stamp duty. How much is stamp duty that was incurred? The figure for the stamp duty. How much is it for the stamp duty? How much is the figure for the stamp duty? 13,000. 13,000. We had what we call enhancement. So that is an enhancement cost. How much is the enhancement cost? How much is the enhancement cost? How much is the enhancement cost? That was 9.8. And again, we have the legal cost card after purchase. Every local politician basically laid a claim on the property. There's a local politician, just like the normal politicians that we have, when they see somebody doing something good and say that this is their property, and you say that that legal cost of a local politician claiming that land part of adjusted cost. So how much was it after purchase? How much was that legal cost after purchase? How much was that legal cost? How much was that legal cost after purchase? Cut by 𝐴𝐵𝐿 after purchase, that is constitute an adjusted cost. How much was it? How much was it? That was 3 million. stick to this at the end. I hope space is enough as I might here. Should be enough. Then you just say less investment allowance. Look at the additional information investment. How much is the investment allowance? Investment allowance. How much was the investment allowance that was agreed? The figure for the fiscally agreed. The figure is so you get the adjusted cost that we need to less. Adjusted cost of the adjusted cost. Just put that we need to less. Add this one. I hope you have the calc. 1.3. 1.3 plus 650, 13,000 plus 9 plus 3,450,000 740. What is the figure we need less? The figure for the adjusted cost less of 14 million 14,473,000. So when you let the transfer value, we get capital gain. What is the capital gain? Capital gain in GAPI. Capital gain in GAPI. 16 million minus 14,473,000. What is the capital gain? So the capital gain is a figure of 1,878,000. 878,000. 1,008,000. Kila mtu ameelewa? Hajaelewa? The capital gain. So you can get CGT. CGT is what capital gain tax. Capital gain is what's called the C. So what is the rate of CGT? Remember that in 2023. Remember CGT change in January. So when you look at September, that is 2022, the rate of CGT at that time was, and the examiner is also very clear. The examiner did not also want to confuse this because the rate had just basically changed at that time in January. So he knew that most likely some students would have used 15%. So the examiner percent. So we get of the capital gain. So 5% times the capital gain, which is 878,000. So what is that? So that is 900. So that is the capital gain tax. Nani hajaelewa? Hiyo iko sawa. I want to teach you something. Why am I teaching you this? So that students, I'm very keen on teaching. When it gets to this calculation, there's a way in which Awiko, unanisikia? Chungule, are you getting enjoy? I've not seen Walter in class, but I hope he will. There's a way work which sometimes most of the people do not understand. There's a way in which calculations were ignored. What we're going to do here in calculations, You can miss to get the answer, but you still have everything. Now, you can miss to get the answer when you're in the past, but you still have almost all the question. How many marks was that for that particular question? Marks. How many marks part A? How many marks was that question? Examine how many questions. 5. So remember, now if I entry. So the first entry is there. Entry 3, entry 4, 5, 3, 4, 5, 6, 7, 8, 9, 8, 10, and there's 11. There's 11. 2, 3, 4, 5, 6, 7, 8, 11. So say it's any 10 times a half. So any 10 times you have the 10 mark, you have the 5 mark, 5 marks. We talk these things because sometimes when I pick an exam, they don't understand it. Just by doing this, for example, fanya hapa na work easy, you already have 2 marks altogether. You already have 2 marks. When you begin to put the entry, you scoop the marks. I teach you this because I don't want you to fall along. I also want to make this very interesting. Together. What I was doing. So that should be done. So then I proceed to the next question. So Lisa, the next question we're being asked. Reason. So being told the citing reason, which of the following forms should use to which form should be used to file the time? From start to 1, what you call the CGT2, what you call the CGT3. So transferring land and property, what you call land CGT2. Transferring land and property, transferring and property. We use CG land and building. It's land and building. So when you talk to your transfer building, you basically use what you call CGT. We call it the CGT1 form. When you use transferring land building, you basically use what CGT. There's the shares here, transfer of shares, but this is assignment. I love giving students assignment. Those who have met me, that we so CGT2P, and then this for individual land and building, CGT1 for individual. So get for me CGT as your assignment. Make sure that before the next class, as we get to a break, another assignment, so that, and this one is just send it. When you're sending it in WhatsApp, because you send it as a picture. Kindly send it as a pic, but send it as a pic. So there's a question on CGT. Open November 2019, either November 2019, because either November 2015 or May 2019, November or May. But you can have it, we check, then I give you that assignment. So that that is May 2019. May 2019. 2019. May 2019. 3B. Question 3B. That is question 3B. Together. Question 3B. That's as for that students who want to do it, you can do it. Break. Come on, do it, then we revert. Then we revert. Assume that this is in. Assume that this 2024. 2024. So that we use 15%. Assumption is this. Assumption is this question. We just say 2024. Occurred in 2024. Assumption that occurred in 2024. Is the point at all? If you can do it, then we do it. If 2 or 3 can do it, revise on the bottom. So if you're together, we respond with this. Go for a break. Perfect. So you can have a small break. Resume. Stopped. Hello, Lana. Can you resume from where you stopped? Resume from where we had stopped. Can we resume from where we had stopped? Can we resume from where we had stopped? Can we resume? Are we there? Are we there? Perfect, if you're there. So we start with the next type of the task question. Have we done the question? So you can present as a sample advanced tax. What is about advanced tax? So this is very charge of motor vehicle on owners of motor vehicle. This is the tax that is basically motor vehicle used for commercial. So say is what you call a tax that is charged on owners motor vehicles, owners of motor vehicles. We say for owners of motor vehicles used for what we call commercial purpose. Charge of owners of motor vehicles for what we call commercial purpose. It is a tax that is charged on that essentially is used for commercial purpose. When do you pay? When do we pay advance tax. Pay that advance tax. But it is usually paid. Usually paid beginning. We call it at the beginning. At the beginning of the year. We call it beginning of the year. What do you mean at the beginning of the year? It is usually paid here. Beginning of the year, what do you think we mean? Say year, the beginning of the year, when is it being paid? Or at the of January. The 20th of January. And the amount that is paid is usually on capacity, sometimes 6. So say the amount to be paid, we say that the amount to be paid is usually dependent on capacity. On capacity, the paid capacity, i.e., seats, number of seats, stroke the number of a motor vehicle, stroke the number of seats of a motor vehicle. Of seats. But the amount that is usually paid on the advance tax is usually stroke the number of seats of motor vehicle of the motor. So then, do you think we charge at which vehicles do we charge advance tax? So say usually chargeable on the taxis, commercial buses, usually chargeable on the taxis, commercial buses, matatus, etc. Bus tax usually chargeable on what you call the this is taxis. We have the matatus, etc. The question is tax. Is it a final tax when we talk about advance tax? Is advance tax final tax? It's usually it is usually understand that it is usually not called a final tax. It is tax, but once you that advance tax, you will offset it against the tax paid at the end of the year. Final tax. However, it is used to offset. However, we know to offset against total against tax payable, total payable. We say at the end of the year. At the end, so at the end of the year. So at the end of the year, you remember that the tax that are paid at the beginning offset against the total tax payable, against the total tax payable, against the total tax payable, total tax. What do you think is the rate if you ask, for example, what is the current rate? What is the current for those who have matatus on the road? What is the current rate of an advance tax? Mind you, remember that advance tax is basically paid at the beginning of the year, and to be very precise, of January on a yearly basis, of January on a yearly basis. And I'll say it's dependent on of seats that the motor vehicle has. Is examples of motor vehicle. But I have to say that the advanced tax is not final tax, meaning that used to offset against the total tax payable at the end of the year. So what is the rate? What is the rate of advanced tax? What is the rate? What is the rate of advanced tax? What is the rate of advanced tax? What is the rate of advanced tax? Changes that were effective in January, changes in August, finance bill of August 2023. The still effective under the finance bill we have August 2023. Just 2023. What are those rates? Advanced tax. I know this is a very common question. Naili kuja in December. This December, if you look at December 2023, usually December tax, this question came on December 2023. The changes were made to the finance bill that is in August. So we need to understand that for pickups, vans pickups, prime movers. So when you look at the pickups, when you look at the vans, lorries, we say that to shillings, 2,500 to shillings per ton, 2,500 per ton, 2,500 per ton of load capacity, of load, call it of load capacity, to shillings 2,500 per ton per year, here. Per year, whichever, or shillings 5,000 per year, whichever is higher, or shillings, whichever is higher. Tuko pamoja. So the finance bill ilikuwa 1,000 per ton, and per year it was basically 2,400. These are effective in the finance bill of August 23. We say that 2,500 whichever is higher. To say that even is one and below, come respond with a yes. If that is noted, we respond with a yes. Asante. So then we move to the next. When you have for the saloon cars, we have the saloon cars. Station wagons, saloon car, station wagon, saloon car, station wagons. We have the minibuses, and coaches. To shillings 100 per passenger. To shillings 100 per passenger. What I've noted, shillings 100 per passenger. Capacity capacity per month, capacity per month, capacity per month, or shillings, 5,000 per, say whichever is higher, whichever is 5,000 per year is higher. Tuko sawa? Kama tuko sawa, tubonyeze yes. Station wagon, minibuses, and coaches to shillings. Initially, it was 60. You know, before the changes, it was 60. It is 2,000 per year. Remember these changes. Look at this. Remember these changes. They were effective. These changes were effective 1st January. So currently they're in force. If you want to pay advance tax, that you're paying, the rates that you're paying. If you're paying advance tax, these are the rates. That you need to pay. Is this understood? Is that understood? Weka tubonyeza yes na tuendelee. So then I'll proceed now to the pseudo taxes, what you call the pseudo taxes. What you call the pseudo stock miscellaneous taxes. The pseudo stock miscellaneous taxes. Pseudo stock miscellaneous taxes. Pseudos, what do you call the pseudos? So what you call miscellaneous taxes. Remember when I was touching on that for topic 1, that is topic 7, topic 13, I cover together. Do you remember that? Because about the pseudo and the miscellaneous taxes, this is a very small area. I cannot wait to cover. I cover the pseudo taxes. So what is a pseudo tax? What are the pseudo taxes? Miscellaneous taxes. Where's the stock the miscellaneous taxes? By the pseudo. When I talk about the basically for particular services that are offered by the government. Look up, these are all levies particular by the government. So say that when you talk about the pseudo stock, the miscellaneous are basically levies, stock taxes for taxes. But something the taxes is that as opposed to say that there's not a direct taxes. Now for the pseudo taxes, taxpayer as what you call a direct, the taxpayer as what you call a direct benefit. Now as what you call a direct. We're talking about the income taxes. We did say as an introduction benefit for paying those taxes. But I've said that pseudo taxes are particularly levied by government for particular services that are offered by the government. And I've said all direct benefit. Is that understood? Perfect. So say our levies, we call them our taxes. So what we call so levies. Imposed, call them government, imposed by the government, imposed by the government, imposed by the government, for the particular services, provided by the government, for particular services, say provided by the government, for particular services by the government. But you see, again, also very important to say that the taxes now are individuals are in a position they enjoy what's called direct benefit. So say that in this type of tax, there's a direct is type this in this so levies. There's a direct benefit. There is what we call the direct and direct benefits to reward, direct benefits to reward to the taxpayer, to the taxpayer. And you say, unlike what we call unlike other taxes, there's a direct rewards to there, unlike other taxes where direct one. Unlike other taxes where there's no direct one. The examples, we proceed to the examples, we proceed. Start with the first example that was basically in exam that was tested from the exam in PhD. I want to start with the first example that was basically tested in the exam, just tested in the exam that we just walked out of. And it tested in question 4A, April 2024, question 4A. It was tested for, and that's the first one. We call it the stamp duty. Stamp duty. The first pseudo miscellaneous tax duty. The same as stamp duty. Is basically by the government, to say on certain and documents, on certain transactions and documents. Levy is a levy charged by the government for a time. In particular, look at the word and documents are which together. So it being one of the first with the government certain transactions and documents. Why do you think we charge some? What is the stamp duty? Why do you think we charge stamp duty? I have not talked to. Joy, why do you think we charge stamp duty? What is it? Why do you think we charge stamp duty? Why stamp duty? Why do you think we charge? The purpose of charging the stamp duty based transaction or the document the reason why we charge stamp duty is to legalize the transaction, is to legalize the purpose of stamp duty. The purpose, that is to say that the purpose of stamp duty is to, we say, legalize transaction transaction, the transaction, what we call the document in question, or the document in question, is to legalize the transaction or the document in question. But the very is to legitimize the transaction or in question. This transaction is stamp duty. When you talk about transactions that are chargeable to stamp duty and to legalize the document of transaction, what are these transactions that we charge stamp duty? What are these transactions that we charge the stamp duty? What transactions that we basically charge stamp duty? What are these transactions that we transfer of land and big? And that's a document but say we transfer of land buildings. For transactions, we know when you talk about transactions, we know that that is land transfer of land and buildings, or transfer of land and building. The transfer and building, that is essentially of land and building. SM Karibu, I hope you join our classes. We have started our classes. Transfer of land, that is essential. But you say that for stamp duty, we know that if you look at urban areas, what is the rate of stamp urban rural areas? What is the rate of stamp duty in the urban areas and in the rural areas? What is the rate of stamp duty in the urban and rural areas? What is the stamp duty in the urban and rural areas? What is the rate of the rate of urban, and then we have 2% in rural areas, in the urban areas, and 2% in the rural areas. So when you talk about that came, the examiner asked in April 2025, transactions and documents that are charged stamp duty. That is what 2 marks question 4A. So then you're able to stamp what you call what are documents that are chargeable to stamp duty? Chargeable to stamp duty. This is stamp duty. Any documents that are chargeable to stamp duty. What are these stamp? We know that number one, we call it memorandum. Memorandum of 𝐻𝐶 is one of the documents chargeable. Memorandum of 𝐻𝐶 as the first duty. We have what we call hire purchase transaction, hire purchase transaction. We have market partnership deed. Is chargeable to stamp duty. And another that is chargeable to stamp duty. We have security. We have the marketable security. apart from the marketable security, title deeds, title deeds, title deeds. We also have what? Title deeds, insurance, mortgage agreements, we have the insurance policies, about bill of exchange, of exchange, so then marketable securities. What is just talk about marketable security? When you talk about marketable securities, the bonds, the securities, those should be marketable securities. Market documents chargeable to stamp duty. Documents not chargeable to stamp duty. What are these documents that are not chargeable? What are these documents that you don't charge stamp duty? Documents that should be easy. What are these documents that are not chargeable to stamp duty? Come on, Danny. That should be very interesting. We say securities we talked about, treasury bills and bonds. Are we together? And international awards is not chargeable. Is not chargeable. That are very clear. We have affidavits. Affidavits is chargeable. Affidavits that is statutory declaration that is not chargeable to stamp duty. Awards. Acknowledge debt. Acknowledgement of debt. Apart from that, acknowledgement of debt. Acknowledgement of debt. Have instruments of divorce. What you call of divorce. Instruments of divorce. Instruments of divorce. Instruments of divorce. Delivery notes. We don't have called. So say for this particular exam, this one came. For this particular exam, that one came. If we are together, we respond with a yes. So then I want us to introduce the next, that is what's called catering. I just want to talk about catering levy briefly. Catering levy. Catering levy. We have a small discussion on the catering levy. What is a catering levy? Catering levy. Nani amesikia catering levy ni nini? When you go to certain, what is a catering levy? Catering levy. What is a catering levy? Assignment pay to cut for catering. That's that's not all hotels. If you go to how do you call it, Mama Kibanda, levy. For certain hotels, I know on SM, have you registered for Focus Online? SM, have you registered with Focus Online College? I want you to register. You can reach me through this. This is the college number. I'm Mr. Dongo. You can, if there's any inquiry, but your name sounds familiar. Your name sounds so familiar. Your name is a bit familiar, but you can reach me through this number. Any issue, you need to join their issue, then you can reach me or you can reach us through the number. So what is a catering levy? To be very precise, catering levy is charged on the of foods and drinks in some hotels, not all hotels altogether, but in some hotels altogether. If you go to look at that receipt, have you ever been very keen on those receipts? You're an accountant, so you must be very keen on. Have you ever seen a levy that is down there in a catering levy? Have you seen it? Very keen. You've gone to certain hotels and you'll find there's what you, if you look at those, there's what you call catering levy. Not need to check those receipts, you're an accountant. To an hotel, let's say not all hotels. If you go to the local Kibanda, you'll not have it. But if you go to the big hotels, you'll find it there. So what is the purpose of that catering levy? Number one, the purpose of that catering levy is basically to improve what you call the tourism industry. Yes, you'll be checking. The purpose of it is basically to improve what you call the hotel industry. The purpose of the catering levy is basically to improve the hotel industries, to improve the not hotels, but to improve what you call the tourism industry. Why do we charge it? It's basically to improve what you call the tourism industry. But essentially, the reason why we levy, that levy is there, what we call the catering levy, is basically to improve what you call the hotel industry altogether. Who knows where tourism fund is? Who knows where the tourism fund is? Tourism, those who are in Nairobi, they know where the tourism fund is. That is in Upper. This levy is basically taken in Upper. What is the rate of the catering levy? What is the rate of what's called the catering levy? Rate yake ni ngapi? Rate yake ni ngapi, the catering levy? The rate is essentially 2% of the gross sales. Normally 2% of the gross sales. Ukiangalia hiyo levy kwa risiti utapata is 2% of the gross
dividends. Number two, we can also say that the debenture holders, may agree with the company, to do what? To convert their debt, into equity, to convert their debt into what? Into equity. So when we talk about converting the debt into equity, this whereby, for example, if you have invested in a company in terms of buying debentures, so the company can basically request you, or can request now all the debenture holders to accept their debentures be converted into what? Into equity. Equity, remember, are ordinary shares. So mean that once the company has converted those those particular debentures into ordinary shares. Number one, the company will not be having an obligation to pay interest. And number two, the company will not be required to redeem maybe those particular debentures. Those particular debentures, once they do what? They mature. And also, we also need to recall that the dividends which are payable to the ordinary shareholders, those particular dividends are not mandatory. It's not a must that the company has to pay dividends to the ordinary shareholders. So the company will only pay dividends to the ordinary shareholders if the company is basically performing what? Performing well. So these are basically good examples of what we call as a scheme of arrangement, or basically what? A compromise. A compromise. Now, I think what I was to give here are basically the steps which are involved. Steps involved in a compromise. Steps involved in a compromise, or basically in a scheme of what? Of arrangement. A scheme of what? Of arrangement. So for this particular scheme of arrangement to be implemented, so which steps need to be followed? So the number of steps, number one, or basically here the company will be required to call a meeting of the members, or basically creditors. So if the company wants to negotiate, maybe the debenture holders, by requesting them to accept the debentures to be converted into ordinary shares, the company will have to convene a meeting of the debenture holders. Remember, debenture holders are creditors to the company. If the company wants to negotiate with the preference shareholders to accept a reduction in the rate of preference dividend, so the company will be required to convene a meeting of who? Of the preference shareholders. And actually, preference shareholders, these are members of who? Of the company. So the step number one is basically calling of a meeting, of members, or basically who? Creditors. So the company here will be required to call a meeting of the members, a meeting of the creditors the company wants to negotiate with, and basically enter into this particular compromise, or basically enter into this particular what? Arrangement. Number two is that the company then will be required to issue. Step two is issue of explanatory statement. The company will be required to issue explanatory what? Statement. So when we talk about explanatory statement, this is basically like a statement issued by the company, regarding the proposed what? The proposed scheme, or basically the proposed what? The proposed arrangement. What is the arrangement of the company? What is the arrangement of the company? Well, basically, what is the company proposing? If, for example, the company is proposing to convert maybe the debt or the debentures into ordinary shares, that information must be very, very clear in this particular statement. And actually, this statement has to be made public, and also it has to accompany those particular notices, which are sent to the members or basically creditors regarding that what? A meeting. So if the company is proposing to reduce the rate of preference dividend, also that must be included in what? That must be included in something called the explanatory what? Statement. So once that has been done, the explanatory statement has been issued. Step number three is that the company will need to obtain a court order approving this particular arrangement here. So we say that a court order must be obtained by the company, approving the proposed what? Scheme. That is approving the proposed what? Scheme. So the company here will be required to obtain a court order, which is basically approving this particular what? Approving this particular proposed scheme, or basically proposed compromise. Proposed what? Compromise. And then from there, and there is something basically I forgot here. Once this particular meeting of members and creditors has been held, So the members who are being affected by this scheme, the creditors who are being affected by this scheme, basically will be required to discuss the proposed scheme, will be required to discuss the proposed scheme, and basically they must approve it through a special word resolution. So if the company is proposing, for example, to reduce the rate of preference dividends, say from 15% to 5%, during this particular meeting of the preference shareholders, that particular proposal by the company will have to be discussed, and basically it must be approved by the preference shareholders, or basically by super majority of the preference shareholders. Super majority is basically not less than 75%, or basically not less than 3/4 of basically the members holding the preference holding the preference shares, holding the preference shares. And finally, the last step, basically, which is step number 4. Step number 4 is basically registration of the compromise. Number 4, registration of the compromise. Registration of the compromise. Registration of the compromise. Compromise with the registrar of companies. Registration of the compromise with who? With the registrar of companies. With the registrar of who? Of companies. With the registrar of companies. So therefore, those are basically the steps which are followed for this particular scheme of arrangement, or basically for this compromise to be what? To be implemented. To be what? To be implemented. So I think that is it. That basically what was required as far as that question here is basically what is concerned. Yes. So I want us to basically move to the other questions here. To the other question, and can someone share that? I can't see my mock paper. Can someone share? Walter, can you share that paper in the class WhatsApp group? Yes, can you share? Can you share? Can you share that paper in the class WhatsApp group? Someone to share, someone to share, someone to share. Someone to share, someone to share. Can't see that paper. I don't know what happened with my phone. Okay, thank you. Yes, so let's basically move to the other questions here. So it basically means that we have answered question number 5. I think as far as question number, okay, let's move to question number 6. Question number 6 here. And question number 6, we are told part A, highlight 3 ways through which an auditor may be appointed. Through ways through which an auditor may be appointed. Basically, first of all, who is an auditor? An auditor, we said, is an independent person who is basically appointed, or is we can say is an expert, is a professional who is basically appointed in order to independently examine the financial statements of the company, and basically be able to do what? Be able to express an opinion. Be able to do what? To express an opinion. So what the question was asking here is basically, how is the auditor appointed? Question number 6. 6A, ways of appointing an auditor. Ways of appointing an auditor. So the auditor, basically, if you can be able to remember our discussion in class, we said there are 4 ways through which the auditor may be appointed, actually not 3. So one is, we talked about appointment. We talked about appointment by who? By the shareholders. By the shareholders, or basically the members of the company. And actually, we said the members of the company do have the right to appoint the auditor during the AGM. So once the company has convened an AGM, we said one of the ordinary business, or one of the business which is transacted during the AGM is basically the appointment of the auditor. So the members have the right to appoint the auditor during the AGM, AGM. And actually, we say the auditor who is appointed by the shareholders is supposed to hold office from the conclusion of that AGM until the next AGM. So in the next AGM, this auditor shall be regarded to be a retiring auditor, unless maybe appointed back. So number 2, we talked about appointment by directors, or basically the board of directors. Now, in this case, we say that the board of directors basically can appoint the auditor in 2 circumstances. One is in case of what? In case of a cash flow vacancy. Cash flow vacancy basically means that maybe the auditor was appointed by the shareholders, for example, has vacated the office, maybe due to resignation, due to death, or something like that. So in case there is a cash flow vacancy, that cash flow vacancy is supposed to be filled by who? By the board of directors, or basically by the directors. Number 2, we said the directors have the powers to, or they should appoint the first auditor. The first auditor. So the first auditor of the company, this is the auditor of a newly registered company. And the auditor of a newly registered company is always supposed to be appointed by the directors, or even or actually the board of directors. Number 3, we talked about the appointment of the auditor, appointment by the cabinet secretary. Appointment by the cabinet secretary. Remember, you said as per the repealed Companies Act, in case the shareholders didn't, or the members didn't manage to appoint an auditor during the AGM, previously we said the auditor was supposed to be appointed by who? The Register of Companies. But as per the new Companies Act of 2015, in case the shareholders of the company have not agreed on the person to be appointed as an auditor during the AGM, it is, or basically the directors of that company should basically go ahead and inform the cabinet secretary. And actually, this should be the cabinet secretary in charge of the docket, in charge of the ministry under which the companies operate. I said currently companies, actually companies operate under this ministry. We have this Ministry of Investment, Trade, or something, Ministry of what? Investment, Trade, and I think something else. So this is the cabinet secretary who must be informed by the directors, and then in consultation with the directors, he will go ahead and basically do what? Appoint the auditor. In consultation with the directors, he will go ahead and appoint who? The auditor of the company. Also, we talked about the other way through which the auditor may be appointed, and that is something called automatic reappointment. Automatic what? Reappointment. So when talk about automatic reappointment, this whereby the auditor who was appointed in the previous AGM shall be regarded to be automatically reappointed back in the office. Or actually, we say that the retiring auditor, remember the retiring auditor, an auditor does not retire because of age. Or basically, when you refer to the retiring auditor, an auditor once appointed in a certain AGM, in the forthcoming AGM, he's regarded to be a retiring auditor, because once you are appointed as an auditor, you should serve the company from the conclusion of that AGM where you are appointed until the next AGM. In the next AGM, you are regarded to be a retiring auditor. So, but you said that retiring auditor shall be deemed to be automatically appointed back in the office unless, number 1, a resolution has been passed appointing someone else someone else as an auditor. Number 2, that auditor is not basically willing to, or has given a notice about his unwillingness to continue serving what? And that particular company, or maybe a resolution has basically been passed by the members removing him from what? From the office. So therefore, this basically we said are the various ways through which now an auditor may be appointed. An auditor may be what? Appointed. Remember, as far as the auditor is concerned, we talked about so many issues, including the qualification. We said, for example, for you to qualify to be appointed as an auditor of the company, 1, you must be a holder of a practicing certificate, which is issued to you by ISPAC pursuant to the Accountant Act. And we said for you to be issued with that certificate, practices certificate 1, you must be a CPA finalist or maybe a CCA finalist. Number 2, we said you must be a registered member of 𝐎𝐍𝐋, a registered member of 𝐎𝐍𝐋. And number 2, we say that you must be a holder of annual license. Annual what? License, which equally we said is issued by 𝐎𝐍𝐋. According to or in accordance with the Accountants Act. So I think basically that is what was required there. Let's move to the other questions here. We move to the other question, here. And the question here was asking about about something we discussed, still in relation to what? In relation to the alternatives. So the question reads, explain 5 strategies that may be employed by the company against a hostile takeover. The strategies to be adopted by the company against the hostile what? Against the hostile takeover. The strategies adopted by the company against the hostile takeover. So first of all, you have to recall, what do you mean by a takeover? Basically, a takeover, which is also known as the acquisition. We say that this is basically one of the alternatives to the liquidation of the company. If the company has been making losses, or basically a company has been struggling financially, now instead of liquidating that company, we say that there are various alternatives. One of which is basically takeover or basically acquisition. We also talked about merger or amalgamation. We talked about external reconstruction. We talked about the internal reconstruction of basically the capital reduction, and so on. So what the question was asking here are basically the strategies that the company may employ against a hostile takeover. Strategies to be employed by a company against a hostile takeover. Against a hostile takeover. A hostile takeover against a hostile what? A takeover against a hostile takeover. Remember what is a hostile takeover first of all. Even before I explain what is a hostile takeover, we said basically assuming we have company A, which want to take over company B. To take over, we said is to buy all the shares. To buy all what? The shares. Maybe company A want to buy all the shares in company B. This one is called a takeover, or basically is called what? An acquisition. So company A want to acquire company B. So we say this company here, which want to acquire all the shares in company B, this company we refer to it as the predator. We refer to them as to this company as what? As the predator. Whereas now this particular company here, company B, this company is basically known as the target company. The target what? The target company. So basically we said for this takeover to be able to take to go through, this company, the predator must make a takeover bid. Must make a takeover bid. Must make a takeover bid. So what do you mean by a takeover bid? A takeover bid basically, we said, is an offer which is made by this company to acquire majority of the shares, or basically all the shares in company B. So once that takeover bid or that offer has been made, a bid is an offer. So this company will be making an offer. We want to buy all the shares from this company and we are offering this particular amount of money. So that bid will be sent to the board of directors of this company. And we said once the directors receive this board, for it not even to be able to proceed to the other level, it must be approved by the board. It must be approved by the board of directors of this what? Company. But we said once the board of directors receive that offer, which has been made by the predator, they can do what? They can reject it. They can reject it. So if they reject that offer, this company here, that is the predator, may decide to use other channels, other means, by the end of the day, to acquire majority of the shares or all the shares in the target company. Now, that basically we refer to it as a hostile takeover. A hostile takeover is a type of a takeover whereby the predator will try to use other strategies. And I think we mentioned about those strategies. We talked about something called the proxy vote. And I think the proxy vote, there was another one, I can't be able to remember the exact name, which will be used by this particular company to do what? To acquire the shares directly from the shareholders of this company, whenever those particular shares are trading in the securities exchange market. So therefore, if this company still is trying to pursue a takeover which has already been rejected by the board of the target company, that one is called what? A hostile takeover. And I think we talked about the strategies which can be employed by this company to be able to acquire this target company despite the offer which was made having been rejected by the board of directors. I think we talked about two strategies: the proxy vote, the proxy vote. When we talk about proxy vote, we said that this whereby this company, the predator, can basically approach the shareholders of the target company and try to convince them to remove those directors who are opposed to that takeover. Remove them, replace them with the new directors who will be able to approve that particular vote. If yes, a proxy vote. Do you have the question? Do you have? There was another one whereby this company was December 2021. Basically, confirm. I can see we have 1 hour 20 minutes. That strategy we must finish this particular question. That name is we must finish that question. What is the name given to that? Okay. The predator. So what are we told? What are we told? That is question number 2. Directed from the shareholder. So the question is law limited, a public limited at a premium. And what is the name given to 80% equity shareholding in which is employed by the company? Another are we told here? What are we told on 1st of April 2024? That so then we are told that the acquisition consideration comprised of an immediate cash payment of 24. So what are we told that there was the approximate on 1st of April 2024? The following I think we will be able to remember as we move. So but we talked about those 2021. So we're given a strategies which can be adopted by the different and then you don't know how the entries have been made property acquired this company. But we say and then we have this company on generated has been able to employ a number of ventures for building a number of inventory avoid lock limited together. So which are those and we talked about it at 5 or 6 trade payables talent to be adopted by the revenue company, a public division cost administrative expense to avoid a public limited takeover. We have some additional limited purchase 50%. Number 1 of shares officers limited for an immediate cash payment for field this and the following financial or this basically involves we prepare the statement of company. So we given the statement of the year which headed study based on trading company agenda of paper and agenda of so we have the statement of financial position to buy a share study first of March the paper and C1. And then we have some additional information. This was basically one but even price above which has been important for us to go through level. The additional information number 1. So we given this information offered by the shares. Actually, there is information a price which is basically above like for the market. That basically so the strategy is basically to be allocated by the number 1 is in number 1 what are we told? Poison pill basically we say we are told that this company that is the target company will make it it is important for you to note that position its shares now before we do that its shares what the requirement and attract you'll be able to see that we are required to come up with financial statement. We know the relationship and the nature of investment actually we say company in the other company when we get the relation information. So this year we started then on 1st of April additional 2020 that so we got the start of the year shares this basically the existing shareholders. So what we are told existing shareholders is that come up with the April shareholders the start of the year the directors of structure establish. So this company make its share statement to show basically by issuing additional shares if the property was revalued to market. So what we have the information about the, so by doing that date, this information independent valuers let's go valued allowed one that should make its shares, and we are told the company building in other terms is a public limited. The remaining right by the 80% at that date shareholding in a company which I call paper, and then you put a public limited company in a creditor with basically 124. So the company which is called excess depreciation, in that case we are able to ignore this company. So if this animal, for example, evaluation with the credit shareholding, so in a company as far as that point is concerned, point number one, because it has taken some point which date revalued. So the value then from there we also talked about anytime part of the company value number two, we talked about we need to determine the current evaluation, and then paper is the crown subsidiary. You can see that is we given the date of acquisition, and then from there once we go number one, paragraph number three, whereby we need to determine paragraph two. In paragraph number three, entails on first of October 2024, the most valuable, selling the most. Remember, they have the business of another property entered here. And actually, there is a company mentioned during the company process whereby the most profitable given business. Effectively, usually comprises 20% of the equity company shares comprises of the most and immediate property. 15. So this company property comprises of we are told profitable 50% share business, and I think in a company which is called 𝐎𝐍𝐋𝐈𝐍𝐄 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirement, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount, with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐎𝐍𝐋. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalued the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby we have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which we are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by paper limited. By paper limited. So we need to make two adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of paper limited net asset approximated the carrying amount, with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by paper. Did the paper limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what? Year. We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here, we had 6 months. So then the proportion of time here is always 6/12. If we had, for example, 2 years, we're interested with the depreciation under charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation under charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation under charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation under charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation under charge. Let's move to point number 2, where we are told 𝐓𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to 𝐓𝐿 Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to 𝐓𝐿, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by paper to 𝐓𝐿, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by 𝐓𝐿 Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, So unrealized profit on inventory on inventory. Remember, and this profit we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. By Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Lock. The unsold goods would be half of the goods which were sold by Paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unrealized profit here? So it will be half to 50, and basically that will be 50 million. So this unrealized profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of Paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. Those are the 3 adjustments which will be made as far as that unrealized profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000. 500 million, that is, because the amount of money which Lock Limited was supposed to pay Paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in CSAS were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company that is paper, paper limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24, and this one, if you go to the balance sheet or the statement of financial position of the parent under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and LOC limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have two. We have the first year which will end first, or basically first April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take one, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings on this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, We don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share over Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax. The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 marks. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always have 3 marks. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case, we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. Two adjustments here. Two adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in scissors. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of scissors and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to scissors, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, scissors was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed, and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less an erased profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? what will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the items which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to record your total in a part. These are some of the items you don't have to compute in an exam. They'll consume a lot of your time, and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to record that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus For this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Sasa, yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is 𝐿𝐿, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we are given the retained earnings of 𝐿𝐿, that is 380. For paper, it is given as what? 1800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. That's yes. And I think for this, what we will do, for this company, I think for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the sisters? Sisters, when was it acquired? I hope you can remember when sisters was acquired. Sisters was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for sisters, we need to have first of all its retained earnings at the end. Its retained earnings at the end for sisters is 12, the value which we have here. Let's be together here. And then we also need to have the profit for sisters for the year. That one we get it from the income statement. From the income statement, the profit for the year for sisters is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of sisters on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of sisters at the start, which you have said is this, minus this, which will give us 560. And then for me to compute the retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and right variable, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and it is profit that will also be deducted from the retained earnings of paper, 50, like that. Like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures, that is 380, this one 2400, this is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 38.60, which basically will give us 93.60. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value. And the NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share log the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary. which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we left here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No, it came to be a deducted there. So we add these two values and they give us 9 what? 940. So the NCI fair value here is basically 940, 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. Bob? 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. AFR, and this also include acquiring a subsidiary and also disposing what? A subsidiary. And then we have the financing activities, and basically these are those particular activities which by the end of the day affect the size and the composition of the company's capital structure. So any activity undertaken by the company, it affects the capital structure of the company. That is the size and the composition is a financing activity, e.g. maybe the issue of shares, the issue of debentures, acquisition of bank loan, maybe the redemption of debentures which have been issued by the company, and so on. And then after classifying the activities into those three categories, in preparation of the statement of cash flows, we have to determine the net cash flows from each of these three activities, basically in that order. We determine the net cash flows of a company in that order. How do we determine this particular net cash flow? So to determine this, we take the cash inflow. Basically, when we talk about the cash inflow, this refers to any money which is flowing into the business. Like once the company sells an asset, the company receives money. Once the company issues shares or basically debentures, the company receives money. So the money which is received or money coming into the business, we basically refer to that as a cash inflow. The other rule is that when preparing the statement of cash flow, any amount which is a cash inflow, we record it in our statement of cash flow as a positive. As what? As a positive. So we take the cash inflows and then to this we less the cash what? The cash outflows. So the cash outflows basically, this refers to any cash which is flowing out of the business. And the rule is that anytime you are preparing a statement of cash flow and you come across an amount which is a cash outflow, then you record it as what? As a negative. Tell me these net cash flows. We take the cash inflows as positives, and then we less cash what? Cash outflows. So basically, we deduct the cash what? Cash outflows. That's why we are saying cash outflows. We record them as what? As negative. So by the end of the day, we will be able to get the net cash flow from operating, investing, and also what? Financing. So maybe the other thing you need to remember very fast is that when preparing the statement of cash flows, basically we have two methods which can be used to prepare a statement of cash flows, or in other terms, to present a statement of cash flows. We have the direct method, and also we have the indirect what? Method. And actually, the difference between those two methods, that is the direct method and also the indirect method. Indirect method is basically how we determine the net cash flow from operating activities. That is the only difference. How we determine the net cash flow from operating what? Activities. That is actually the difference between these two methods. So under the direct method, basically, we determine the net cash flow from operating activities using a direct approach. Basically, we go to the cash book prepared by the company. Number one, we take into account the cash received from debtors or customers, which is basically a cash inflow. Then to that, we less the cash paid to the suppliers or creditors. We also less the cash paid for operating what? Expenses. We also less the tax paid and the interest which was paid. We will be able to get the net cash flows from the operating activities. That is now using the direct what? Method. Now, under the indirect method, we compute the net cash flows from operating activities using what? Using an indirect approach. And actually, what we do under the indirect method, we take the profit before interest and tax, and usually we adjust it with three items. The non-cash items, which were added or deducted in arriving at net profit. Number two, the changes in working capital, basically where we consider three items of working capital: receivable, inventory, and payables. And also we adjust that profit with any investing or financing activity item which was added or deducted in arriving at net what? A profit. So basically, I think that is the first thing you need to remember as far as the statement of cash flows is what is concerned. And I think with that particular quick recap, I want us to go straight to a question. And there is a question which has already been shared in the class chat box, maybe for those who are joining us right now. So there is a question which has already been shared in the chat box. So if you can be able to see that question, please confirm that is the question you want us to do. Can you be able to see that question, those who are just joining? If you can be able to see that question, please confirm that is the question I want us to do. Can you see that question in the chat box? Can you see that question in the chat box? I want us to use the question from CPA Foundation level. CPA Foundation level. That is the question 4B of August 2024. Yes, so can someone reshare that question afresh? Evans, please reshare that question afresh. Reshare that question afresh. Reshare the question afresh. Yes, so I think it has already been reshared there. It has already been shared here. So let's go through it. We see what we are told and equally what the examiner was requiring here. So the question reads, part B, question 4B, it reads, the following are the financial statement of Precious Limited for the year which ended 31st of March 2023 and 31st of March 2024. So we are given Precious Limited statement of profit or loss, which is for the year which ended 31st of March 2024. We have the gross profit operating expenses. We have other incomes which include interest income received, the gain on sale of investment, and then we have the loss on sale of plant. And then from there we have the interest paid, the interest expense which was paid, and then we have the net profit before tax. We have the income tax for that year, and then we have the net profit after tax. So then from there we have the statement of financial position. We are given statement of financial position basically for 2 years, 2023 and 2024. It is important for you to note that anytime you come across a question for cash flow, always the examiner will give you the statement of profit or loss for the current year. And then for the statement of financial position, that is basically the balance sheet, you'll be given the statement of financial position for the current year. For example, in our case, the current year is the year 2024, and for the previous year. So what you need to note is that the figures which are given here in the statement of financial position of the previous year, 2023, these are treated as the opening balances, whereas the figure we have here in the statement of financial position for 2024, those are closing balances. That's basically what you need to know. So we have the non-current assets, which include PPE, property, plant, and equipment, at cost and also accumulated depreciation. We have the investment, we have the current asset, which include inventory, account receivable, cash, prepayment, and then we have the total current asset and the total asset. And then we have liabilities and capital, where we have ordinary share capital, revenue reserve. Revenue reserve, this is another name for the retained profit, or is basically another name for the retained what? Earnings. Then from there, we have the long-term liabilities, which include both. We have the current liabilities, which include account payable, accrued liabilities. And then we have tax payable. And then we have the current liabilities, total equity and liabilities. Then we have additional information, number 1, all the way to note number 7. So what then are we required to do here? We're required to prepare a statement of cash flows, which is for the year which ended 31st of March 2024, in accordance with the International Accounting Standard number 7, which governs the preparation of the statement of cash flows. Now, in this case, number 1, recall what we have said. There are 2 methods which are used in preparation of cash flow. We have direct method, we have indirect method. But if you check on this particular question, the examiner has not specified which method we need to use, whether we use the direct method or basically whether we use what? We use the indirect method. But anytime you come across a question for cash flow, you are given the income statement or the statement of profit or loss, statement of financial position. If the examiner is not specific on which method to be used, always use the indirect method. So the indirect method basically has so many free marks when it comes to computation of the cash flow from operating activities. So that is the first thing you need to do. The other thing, assuming this is a question you are doing in an examination setup, it is not advisable to start with the workings, because this where or what make majority of the students to fail in these particular questions. So how do you get free marks, or basically what you refer as the low-hanging fruits? So basically what you need to do is that once you come across a question for cash flow, number 1, never start with the workings. Just go straight to what the examiner is requiring you to prepare, because the 16 marks which are allocated here, they are allocated for preparing a statement of cash flow. So if you do all the workings, they are correct. By the end of the day, you fail to prepare the statement of cash flow, you will get 0. So therefore, what you do, go straight to preparing what is required. Basically, any working which you do it per need basis. You are doing a working to determine an item to be posted in the statement of cash flow. So therefore, what we do, we go straight to preparing what is required. And actually, we need first of all to have the title. So the name of this company is Precious Limited. Precious Limited. And basically, this is the statement of cash flows. The statement of cash flows. And basically for the year, which ended 31st of March 2024. 31st of March 2024. Obviously, you must have the title. You must have the title of what you're preparing. And then from there, you need also to remember, in preparing this particular statement of cash flows, we have to determine net cash flow from 3 activities. So can you have those particular 3 subheadings? So basically, always, we start by determining the cash flows from operating activities. That's basically what we know. We start by determining the cash flows from operating activities. So here we need to have 2 columns, and I hope you can be able to see that if you go back to that question, all our figures are given. The figures in the income statement or the statement of profit or loss, the figures in the statement of financial position, they are given in thousands of shillings. So you need to have 2 columns here like that. So then from there, you leave some enough space here, because when computing the cash flow from operating activities, we have so many items which we record here. So leave enough space. And then from there, you have the other subheading for basically determining the cash flow from what? The cash flow from investing activities. And basically, remember, in this case, we have said investing activities are those activities which involve acquiring assets and also selling assets. So what we record here are the assets which were acquired, the assets which were purchased, and the assets which were sold. So we don't have so many items which we record here. Leave just enough space, not a big one. And then from there, we have the other subheading for determine the cash flow from the financing activities. And actually, all the items which we record here, we get them from equity and basically the non-current liability section of the statement of financial position. All the items which we record here, we get them from the balance sheet, specifically at the equity and non-current liabilities. And then down here, we come and we record something known as the cash and cash equivalent. This is cash and cash equivalent, a balance, a brought down, and also we record the cash and cash equivalent, a balance carried what? Balance carried down. Balance carried what? Balance carried down. That's the first thing you need to have anytime you come across this particular question for what? For cash flow. Anytime you come across this particular question for cash flow. And then having that now, I want we proceed and we look on how then do you get the low-hanging fruits. So there are the low-hanging fruits. Remember, we have said that these are the free marks. These are the marks basically you get without any working, without any what? Any working. So basically the first thing I advise my student to record is this: cash and cash equivalent at the start and also at the end of the year. So what do you mean by cash? Cash, basically, you can be able to record, this is cash in hand, cash at bank overdraft, and then cash equivalent. These are the short-term investments. The short-term what? Investment. So basically what we need to do is we go to our statement of financial position under the current assets. We check whether we have cash in hand, cash at bank, short-term investment, and then still we will go to where we have current liabilities. We check whether we have a bank overdraft. So can we do that? The first thing, we go to the statement of financial position, specifically under the current asset. So under the current asset, can you tell me which item of cash and cash equivalent do we have there? Which item of cash and cash equivalent do we have under the current assets? So tell me which item of cash and cash equivalent we have there. Which item of cash and cash equivalent do we have? Do we have under the current assets? Type it in the chat box. Yes, I'm told the first one is basically cash. Is actually what? Cash. You also check, do we have bank balance? No, we don't have bank balance. Do we have any short-term investment there? No. So therefore, and remember what we have said, that we are given statement of financial position for 2 years, 2023, 2024. So the balances we have here, these are opening balances. In other terms, these are what we refer to as the brought down. The brought what? Down. Whatever we have here, these are closing balances. This is what we refer to as the current what? Down. That is also very, very important. Very, very important. So therefore, what we have is cash. So what we do, we take cash, and basically the cash, we take cash at the start from the statement of financial position for 2023, and I hope you can see that is a figure of 2250. And then from there, we go to where we have the current liabilities. We check, do we have a bank overdraft? So under the current liabilities, do we have a bank overdraft? Yes or no? Do we have a bank overdraft? Yes or no? Under the current liabilities. Do we have a bank overdraft? No. So but if we had a bank overdraft is basically money which is owed to the bank. We come and we raise it here. So therefore, the cash and cash equivalent at the start is how much? Is 2250. So we do the same. We do the same at the end of the year. So by now we know that we only have one component of cash and cash equivalent, and that is basically cash. So what we will do, we will take the cash and cash, the cash balance at the end of the year, and basically that is an amount of how much? That is an amount of 69. That is an amount of what? Of 69. Yes, someone can, someone to share that question, in the chat box. Someone to share that question in the chat box. Someone to share that question in the chat box, please. Someone to share that question. Someone to share that question in the chat box. Okay, it has already been shared, Janet, there. I hope you have seen it. Yes. So that is the first thing you record. And in most of the cases, what is important for you to note, what is marked in these particular questions are the entries. Are what? The entries. And basically, mostly this particular question for cash flows, how are they marked? This is how these particular questions are marked. So like you can see the marks are located here were 16. So mostly these particular questions will be marked like this. Any 8 correct items here, you are given 2 marks. So mean that if you get 8 correct entries here, you'll get 16. Alternatively, if the question has so many entries, the question can be marked like this. Any 16 entries at 1 mark, and basically you get what? The 16 mark. So it depends with the number of entries. So if a question do not have so many entries, it can be like marked like that. If the question has so many entries, it will be marked like that. So therefore, what is important here is not by the end of the day to do so many workings here. What is important when preparing a statement of cash flow are the correct entries you make here. Are the correct entries you make what? In the statement of cash flow. For example, those 2 correct entries, those 2 entries, they are correct. Those are already 2 ticks. Yes, after doing that, then we come back here to where we compute the statement of, or actually we compute the cash flows from operating activities. And remember, in this case, I've said here, we are preparing this particular statement of cash flows using the indirect method. So under the indirect method, we compute these particular cash flows by starting here, or here we start with the profit before what? Before tax. When computing this, we start with the profit before tax. Where do we get the profit from before tax? We get this from the income statement. Can we go to the income statement? You give me the profit before tax. How much is the profit before tax from the income statement? How much is the profit before tax from the income statement? So in our case, it is referred as net profit before tax. Net profit before tax. Can you see that one? Net profit before tax? Yes. So the net profit before tax is basically an amount of 3450. But if you can be able to recall, we said in computing this particular cash flow from operating activities, we should start with the profit before interest and tax. In other terms, what is known as the operating profit. But if you check, in our case, we don't have that operating profit. So therefore, what we say is that to this particular profit here, the first adjustment which we make, or the first adjustment to this profit, is basically to add back the finance cost, which is also known as the interest expense. The interest expense. And actually, this interest expense is always above that profit. Is always above that profit. So can you see that figure of the interest expense? Yes, the interest expense is the same. That is an amount of what? 3450. And actually now that will give us the profit before interest and tax. And then from there we say to this particular profit, we need to make a number of adjustments. The first adjustment we make to this profit is basically to adjust it with the non-cash items. We said the non-cash item, for you to be able to remember the non-cash item to be adjusted to this profit, just remember that acronym. The acronym is 𝐷𝐿G. 𝐷𝐿G. So this stands for what? This stands for depreciation. This stands for depreciation on property, plant, and equipment. This one stands for impairment loss. Impairment loss on goodwill. Impairment loss on goodwill. A stands for amortization. Amortization of intangible assets. Amortization of intangible assets. Then this one stands for loss on disposal. Loss on disposal. So the loss on disposal is basically whereby the company disposed or sold some assets during the current year, and basically the asset was sold at a loss. It was sold at what? At a loss. And this one is basically stands for gain on disposal. This one stands for gain on what? On disposal. So therefore, what we need to do, we need to go to the additional information. But I think even before you go to the additional information, because most of these items will be given in the additional information, on the face of the income statement, there are a number of items we need to adjust to these. We need to adjust to this profit. So can we go back to the income statement or the statement of profit or loss, and specifically whereby we are given other incomes? Specifically whereby we are given other incomes. So where we are given other incomes, number one, we are given something called the interest income received. Now, interest income received is that an income from operation? That is the first thing you need to ask yourself, because what you want to determine here is the cash which was generated from operating activities. Now, anytime you're given an interest received, a company receives interest as a result of having invested. So therefore, what you do, because that interest has already been included here, you come here and you less it. So first of all, we can skip all these items, and then we take the interest which was received, interest income which was received, which has already been added in this profit. So the reason why we are raising this is because this is not an income from operation. So this is an income generated by the company from what? Investing. So you raise it from that profit, and then you come and include it here. So that is the interest income which was received. And remember, this is money which was received. So when recording it here, you record it as a positive. So why are you recording it there as a positive? It is because it is cash which was received, is an inflow. But here we're recording it as a negative. Why? Because we want to eliminate it here from this profit. It is included there, but it's not income from operating activity. So you less it here, and then you bring it there. That is the first item. Then still under the other income, we have the gain on sale of investment. So the gain on the sale of investment. So anytime the company sells an asset, be it an item of PPE, and that item is sold at a gain, so that gain is usually accounted for as an income, but basically we say that is a non-cash item. That is a non-cash item. So take into account it is included there. What do? Place it down there. Then also below that, the gain on the sale of investment, we have the loss on sale. We have this. So the loss, basically this is 450. You can see the loss in arriving at this particular profit, it has been deducted. It was accounted for as an expense. So, and because this is a non-cash item, what we need to do, we need to add it back. Actually, these non-cash items, basically which we have here, depreciation, impairment loss, amortization, and the loss on disposal, because in arriving at this profit, they had been deducted, what you do, you add them back. But now this gain, you do what? You less it. That's basically what you need to remember. Yes. So you can see that all these are free months. All these are free months. This is basically what we refer to as low-hanging fruits. These are basically months which you're able to get in this particular question without any struggle. Without any what? A struggle. You can see so far we have not done any working, but you have so many entries here. Yes. Now, having said, I think we need to go to the additional information because we don't have anything else we can be able to pick from the statement of profit or loss. Let's go to the income statement. Not the income statement, in the additional information. In the additional information number 1, we are told Precious Limited purchased investment worth 11.7 million during the current year. So this company purchased investment. So if a company purchased investment, remember is a form of an asset. And that's why if we go back to our statement of financial position, specifically where we have the non-current asset, you'll be able to see we have the property, plant, and equipment. We have accumulated depreciation. Below that, we have investment. So we have said those particular activities which involve acquiring and disposing assets, they are what? Investing activities. So that purchase of investment, you come and you record it here. Purchase of what? Purchase of investment. Purchase of investment. So the investment which were purchased were 11.7. And I hope you can be able to remember, all the figures we are given in the income statement of financial position, the last 3 zeros are omitted. So anytime you are taking a figure from the additional information, you must do the same, omit the last 3 zeros. Then you also need to remember our rule here. When preparing the statement of cash flows, we have said this rule is very, very important. This rule is very, very important, that any amount which is a cash inflow, we record it here as a positive. Any amount which is a cash outflow, we record it in our statement of cash flow as what? As a negative. So now who can tell us this particular amount here? Once the company purchased an investment, is that an inflow? That particular amount there, is it an inflow or outflow? The company purchased an asset. Is that an inflow or basically outflow? Inflow or outflow? Who can tell us? Inflow or outflow? Yes, automatically this one is outflow. This one is what? Is outflow. So take into account is an outflow. We record it here as a negative. Don't forget, if you record it here as a positive figure, It is wrong because the person is marking will only give you mark if it is recorded as an outflow. We are done with that. Let's move to note number 2. We are told the company sold a new investment that had cost 13.5 for 15.3 million. So we have sale of investment. So remember what we consider here is asset which were acquired, asset which was sold. So in that case, we can say there was sale of investment. There was sale of investment. And basically, once the company sell an asset, what do we consider here? What we consider here is the proceeds. When talk about the proceeds, this is the money you receive after selling an asset. If you sell an asset, how much cash do you receive? So in that case, we are told in note 2, that investment had a cost of 13.5. It was sold for 15.3. How much cash was received in that case? Is it 13.5? Is it 15.3? How much cash was received? Who can tell us here? The cash inflow, the sales proceeds, that basically what we consider here. Yes, I'm told by Evans that the cash received here is 15.3. 15.3. Eunice, yes, that is very much correct. 15.3. And then 15.3, this is an inflow. When you sell an asset, you receive money. You sell an asset, you receive what? You receive money. You receive money. Yes. So basically, that is it. That's what we need to recognize there. So we are done with that. Let's move to note number 3. We are told during the year, a new machinery worth 18 million was acquired. Was what? Acquired. That is also another free entry here. So the company acquired a machine. So once the company acquired a machine, that is still an investing activity. So we say there was acquisition of what? Of a machine. There was acquisition of a machine. You can see the number of entries we have in our statement of cash flows, yet we have not done any working. Have we done any working, Kelvin, here? Have we done any working, Eunice? Have we done any working, Evans? We have not done it. And you can see the number of entries which we have. So because I've said what is marked in these particular questions are these entries. That's not. This is basically what we refer to as the low-hanging fruits. This basically marks you get without a lot of struggle. So then you are told in the same point number 3, sentence 2, some item of property, plant and equipment had a cost of 1.5 and accumulated depreciation of 300,000 were disposed for 750. So many free marks here. So we have disposal. Disposal, remember, is the same with the sale. Is the same with the sale of an item of PPE. What do we consider here? What we consider here is the proceeds. So that item of PPE which was disposed, we are told it was disposed for how much? Can you see the sales proceeds here? So that item which was disposed, was it disposed at 1.5, 300 or 750,000? It was disposed for how much? What is the sales proceeds? That is basically what we consider here. If the amount which you consider here is 750. The sales what? The sales proceeds. So basically we are done with that point. Let's move to point number 3. Point number 4. We are told included in the operating expenses for the year which ended 31st of March 2024 is depreciation charged, and the depreciation charge for the year which amounted to 5,550,000. So in our case, we come back here. We're given this depreciation, which is 5,550,000. That is another free entry. So, and we said that this is a non-cash item. It was deducted in this profit. We add it back. That's why we say this part, these 4 items there, we add them to the profit. So we are done with that. So we move to point number 5. We are told the company issued bonds worth 15 million at a face value in exchange of a plant asset on 31st of March 2024 and repaid bonds worth 7.5 at the face value, at the face what value. Now in that case, we are given 2 transactions in 1.1. We are told the company issued bonds. Bonds are basically the same with the debentures. So bonds are the same with the debentures. So means that if you go to the balance sheet, to the statement of financial position and the non-current liabilities, you should be able to see bonds there. And I hope you can see that in our statement of financial position and the non-current liabilities, we have both. Bonds are basically the same with debentures. We are told that there were some bonds which had a value of 15 million, which were issued in exchange of a plant. Let me first of all ask, is this, or do we have any movement of cash there? The moment the company issued bonds in exchange of an asset, do we have any inflow or outflow to the company? Do we have money flowing in or money flowing out? You issue bonds, you receive an asset. You issue boats, you receive an asset. Is there any movement of cash there? There is no movement of cash. So therefore, what is important to note is that when preparing a statement of cash flow, actually from our definition, I said, it is prepared to show the sources of cash and the application of that cash. How was the cash generated by the company utilized? So therefore, in preparing a statement of cash flow, any transaction which does not involve movement of cash, any transaction which does not give rise to cash outflow or cash inflow, we don't consider it here. Sasa, yes, like that transaction will not be considered here. It's a non-cash item. But also on the same point, you're told the company repaid boats. So when talk about repaying boats, you see boats are issued by the company for the company to borrow money. So the company usually will have agreed with those who will buy boats that they will be given back their money after a number of years. For example, the company can issue boats having a life of 5 years. So meaning that the holders of the boat will be given back their money. In other terms, the company will pay back those particular boats at the end of the 5th year. So once the company repay boats, that is a cash outflow. And where do we consider that? We consider that here. That's why we said all the items which we record here, we get them from equity, non-current liabilities. We know both are part of the non-current liabilities. So here we will come and we say there was a repayment of boats. There was a repayment of boats, basically which had a value of 7.5. And this is cash outflow. The moment the company repay back the boats, which had been issued that involve cash what? Outflow. So we are done with that point. So let's move to point number 6. And you're told the company issued 2.25 million ordinary shares of shillings 10 per, basically per value. So where do we consider this? This one is considered here. And basically, can you go to where we have, because that basically affected the share capital. Let's go to where we have share capital, share capital, share capital. And basically in that case, you can see the share capital increased because remember in our case, we are given a statement of financial position for 2023. I've said these are opening balances, and 2024 basically, which you have said are closing balances. So you can see the ordinary share capital at the start was 47 to 50, and then at the end of the year, the share capital increased. So the reason why we have an increase in share capital is because the company issued shares. So who can tell us how much is the increase here? The increase is how much? The increase, that increase in share capital is, I'm told by Evans, is 22,500. So basically, as per point number 6, we are told this increase was due to issue of how many shares? The company issued 2250 ordinary shares, each share having a value of 10. So if you multiply this, the value of each share with this one, you'll see that will automatically give us that amount. So when the company issues shares, that one is considered here is a financing activity. The company issue a share to do what? To raise finances. So we say there was issue of ordinary shares. So how much amount was received? 22.5. So an amount received by the company is a cash what? Inflow. So we consider that here. We consider that here. Yes, we consider that there. So then after that, we move to the last point. Number 7, the company paid cash dividends of 1.2. This was a very, very simple question. Almost everything is provided. So once the company paid dividends, those dividends paid are recorded here. So we say cash dividends paid. Cash dividends which were paid how much? 1.2. So the moment the company paid dividends, that is a cash outflow. That is a cash outflow recorded here as a negative. Recorded there as what? As a negative. Are we done with the notes? Yes. Can you see the number of entries we have here? Even if, for example, the question was marked like this, because this one automatically, you can see it has so many entries. So automatically, for every 16 ticks, 16 correct entries, you get a mark for each. And basically, by the end of the day, you get how many marks? 16. Can you see the number of entries we have? Basically, we have not done any working, but you can see the number of entries we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. If you decide to read that question like that, you'll be having all the marks. You'll be having all the marks. And basically, that's a question which you should be able to do within not even more than 30 minutes. Because the other thing, maybe for those who are doing the CASNEB exam for the first time. So you'll come across a question with 5 marks, 5 questions, sorry, 5 questions. You're given 3 hours. So if you take 3 hours times 3 hours times 60, that basically comes to a total of 180 minutes. 180 minutes. So this basically to handle how many questions? 5. So if you take 180, you divide with 5, basically this will give you 36. So it basically means that this question should not take more than 36 minutes. More than 36 what? Minutes. That's why it's basically important for you to know the approach to use, because if by the end of the day you start with doing the workings and then later on you prepare this, you'll spend a lot of time. So you may see that you're spending one full hour to do one question. And basically, remember, you have 4 other questions. So that's why it's very, very important for you to be able to know the approach to use in doing these questions in an exam. Other than knowing the approach, number 2, you should also be able to know how to harvest the low-hanging fruits, how to get the free marks. The free what? The free marks. Now, after doing that, there are other free marks here you should always get. You should get down here. And basically that is in relation to the changes in working capital. These are also free marks. Changes in working capital. Now, here, remember we consider majorly 3 items. 3 items. And for you to be able to remember the items we consider here, just recall that acronym. Just recall that word. Just recall this acronym here. RIP, receivables, inventory, and what? And payables. That is basically what we do, what we consider here. So Juma is asking, so workings don't carry any single mark. No, Juma, workings do not carry any single mark. In fact, having marked these papers for a number of sittings, I know those who mark, the moment you start with the workings, you just put cross line like that. So if you, for example, you have the first page and the second one is working, just a cross line like that. So the person who is marking this question for you will be checking, did you prepare the statement of cash flow? And now, if you prepared this, he will come and check these correct entries. So that's where the marks are. Never start with workings. Those workings, by the end of the day, they do not earn you any marks. They just consume a lot of your time. And I've said any working you are doing here, do it per need basis. You are computing an item to be posted here. Don't compute something which is not required to be posted here. Do all the workings per need basis. Because knowing that approach, Juma, is very, very important. It will save you a lot. It will save you a lot. Yes. Let's come back here now. Let's come back here. I want us to still do another question like this. So here we consider 3 items: receivable, inventory, and payables. So receivables, inventory, and payables. But basically I've said, remember this acronym. Not less in piece, but this one stands for the receivables, inventory, and what? And payables. Now, what we need to do basically here is to do what? Is to determine whether there was an increase or decrease as far as these 3 items are concerned. Now, to make it very simple, here there is a formula I give my students. So here we take this. I'll be able to explain what you mean by that. O minus C. And then here C minus O. Yes. So just remember that. O minus C, O minus C, C minus O. So what is this? This is opening balance minus closing. Opening balance minus closing. Closing balance minus opening. So you apply that formula. Whatever you get by applying that formula, if it is a negative, you record it as a negative. Whatever you get by applying that formula, if it is a positive, you record it as what? As a positive. Yes. So we start with we go to where we have our statement of financial position under the current asset. We know inventory and receivables is part of the current asset. So can we start with the first item? And that is the inventory. So we will take the opening, which is 16.5 minus the closing. Opening minus closing. 16.5, which is the opening, minus closing, which is 21.6. 21.6. What do we get? What are we getting here, Eunice? Yes, we are getting negative 51. So record it as a negative. That is an outflow. That is what? An outflow. And basically that is inventory. That is what? Inventory. That is the inventory. That is the inventory. And then from there, we do the same. We do the same for receivables. Receivables, we do the same. Opening minus closing, 8250 minus 7050. So we get positive what? Positive 21. Positive 21. So we have that. But now, before we move to receivables, sorry, to payables, I hope you can also be able to see under the current asset. Below cash, can you see we have prepayments? Can you see we have prepayments? Yes. Now, prepayment is basically part of receivables. It's part of what? Receivables. So in case under the current asset, under the current asset, in most of the cases, will be given the account receivables, and other receivables, If you're not given other receivables, the examiner will give you prepayments. Other receivables can also be known as what? Prepayments. So what we consider here is the trade or the account receivables and other receivables. So in case you're given prepayment, also you have to consider that here. Are we together? Yes, because this is one of the items most of the students will not consider here. So prepayment, basically, I've said, is the same with other receivables. We are going to use the same formula. Opening minus closing, because the same with the receivables. So can you do that? Opening minus closing. Opening minus closing, what are you getting? That is giving us negative, Negative 600, Negative 600. Yes, I'm waiting for the answer. I'm not getting the answer fair. Please give me the answer. I'm saying under the current asset we have, below cash we have prepayments. Below cash we have prepayments. We have prepayments. It is positive, Yeah, it is positive. Okay. So then we got where we have current liabilities. We consider payables. Current liabilities, payables. For payables, we use this formula: closing minus opening. Closing, which is 75, minus opening, 6450. So which is giving us what? Which is giving us 1050. Are you getting 1050? I'm not getting the answers here. I'm not getting answers. Juma, give me the answers. Eunice, Paul, give me the answers here. Give me the answers. Hussein, Felix, I'm waiting for the answers. Zipporah, give me Morimu the answers here. Give me the Morimu the answers. Okay, yes, that's basically what we have. It is also important here also under the current liabilities, just like what I've said under the current assets, under the current liabilities, you also need to check whether you're given something like accrued expenses or maybe accruals. So what else do we have there? We have, yes, there is something also we are going to consider here, and that is accrued liabilities. Now, the accrued liabilities, that one is the same with the accruals. So, yes, other than considering the payables, you also consider other payables. Other payables can be accruals or maybe accrued expenses. So we also consider that here, and that is the accrued liabilities. Accrued liabilities. Accrued liabilities, we use the same formula here, this one, closing minus opening. Closing minus opening, closing 18 minus 1350, which will give us what? 450. 450, is that what you're getting? 450? Yes, 450, which is basically positive. That's what we consider there. Then I think we're almost done. Two other items which are also important here. Number one is the tax paid. And number two, the interest or the finance cost which was paid. Now, for the tax which was paid, this one we need to do some working. So which is not complex, because what we consider are two items. One, if we go to the income statement, we have the income tax expense for the current year, which is 1050. And then if we go to where we have current liabilities, we have tax payable. So how do we compute the tax which was paid? To compute the tax which was paid during the current year, I want you to be very keen. We take the accrued tax at the start. At the current liabilities in the balance sheet, how much tax was payable at the start of the year? The tax payable at the start of the year was how much? Was 750. So this is the tax the company was supposed to pay during at the start. And then to that, we add the tax which was payable during the current year from the income statement. From the income statement, our company was supposed to pay a tax of 1050. So this is the total tax the company was supposed to pay during this year. And then less the tax which are not being paid at the end. The tax which are not being paid at the end is what we have in the balance sheet under the current liabilities, and the tax which are not being paid was 450. It basically means that the difference here is the tax which was paid. Is the tax which was paid. So this will give us tax paid of how much? I've taken the tax the company was supposed to pay at the start, the tax the company was supposed to pay during the current year, and then I've deducted what are not being paid at the start. And basically that will give us what? 1350. And then for the interest which was paid, this one I think is quite straightforward. You consider two items, the interest expense in the income statement, which was this one, and still you go to where we have current liabilities, you check, do we have any accrued interest? In case we have accrued interest under the current liabilities, you use the same approach we have used for tax there. You should take the accrued interest at the start plus the interest in the income statement, this one, minus the accrued interest at the end, which basically give us what? 3450. That is basically the tax which was paid. Not the tax, rather, the interest which was paid. And in our case, we are done. That question, don't even bother trying to add anything. Don't bother adding anything. The person who is marking your paper will be interested with these entries which we have here. He will be interested with these entries. So he will mark these entries. These what? These entries which are here. These entries which are here. These are the entries which will earn you the marks like that. Not even the workings. Not even the working. So that is basically what will be marked. And therefore, as you practice, can you try to use this particular approach here? This basically will save you. This will do what? Will save you in an exam. This will save you in what? In an exam. I want us to do another question. I want us to do another question for cash flow. I want us to do another question for cash flow. Another question for cash flow. Another question for cash flow. For cash flow, we can pick another one, just a random one. I want us to go to the question for August 2023. August 2023. August 2023. August 2023. August 2023. August 2023. Still from CPA foundation level. Still from CPA foundation level. CPA foundation level. CPA foundation level. Yes, and maybe for those who are joining our class here for the first time, who are not part of our students. So our block revision actually started today. This should be our first class for revision for financial accounting, and yes, financial accounting. So if you know of a colleague who is basically preparing for August 2025 exam, is not well prepared, you can basically talk to him or her to join us, to join our revision. Right now we have an early bird discount. Basically, if a person pay for our blocks, we are just charging as low as 1,500 per word per unit. So basically, this will help you in terms of accessing our revision for the next 4 weeks. So our revision classes will take place from today, which is basically is 21st of August up to 16th. This is the 21st of July up to 16th of August. So basically, this will be a 4-week marathon for revision classes. So if you know someone who is preparing for this exam, the August exam, is not well prepared, or maybe he wants to prepare, so you can talk to him or her basically to join our revision classes. I've said we are charging 1,500 for all the units, but maybe for those who are doing BDA, Business Data Analytics, this is an exit paper in CPA. For that paper, we are charging 2,000. That is an early bird discount. It will expire tomorrow. So if you take the advantage of the discount, basically that will be better. So from tomorrow, the amount now will go up with 500. So that question has already been shared here by Evans. August 2023, which is question number 4. August 2023. Question 20, question what? Question number 4. So what are we told here? The question is, we are told the following information was extracted from the financial statements of 𝐵iashara Limited for the year which ended 30th of June 2023, 30th of June 2023, 30th of June 2023. So we are given the statement of financial positions here. That is the statement of profit or loss for the year which ended 30th of June 2023. And then we have the statement of financial position for 2023 and basically 2024. So in that case, we have said 2022, the figures given there are opening balances. 2023 are the closing what? The closing balances. The closing what? The closing balances. The closing balances. So we have basically that statement of financial position. We have the additional information, number 1 all the way to note number 5. So what are we required to do here? We are required to prepare the statement of cash flows for the year which ended 30th of June 2023 in accordance with IAS 7. Is the method to be used specified? No. But I've said if you come across a question for cash flow and you're given the income statement of financial position, always use the indirect method. So then from there, we're required to comment on how 𝐵iashara Limited has generated and used its cash and cash equivalent for the year. So you can only be able to comment on that after preparing the statement of what? Of cash flows. After preparing the statement of cash flow. So we have said never start with the workings, just go straight to what is required by the examiner. So the name of this company is 𝐵iashara Limited, and this is the statement of cash flows. The statement of cash flows, which is basically for the year which ended 30th of June 2023, 30th of June 2023. 2023. So here we start by determining the cash flow from operating activities. Cash flow from operating activities. We need to have 2 columns here. And I hope you can also be able to see our figures there are given in thousands of shillings like this. Are given in thousands of shillings. Are given in thousands of shillings. Yes, so we have said we leave enough space here. Then we have the other subheading for computing the cash flow from investing activities. And I hope you can be able to recall investing activities. These are the activities involving acquiring and disposing assets. And then we have the other subheading for determining the cash flow from the financing activities. Remember, I've said all the items which we record here, we get them from equity, non-current liability section. And then down here, we come and we record the cash and cash equivalents. Cash and cash equivalents at the start, and the cash and cash equivalents balance carried down. So that is the first thing you need to have there. That is the first thing you need to have. You need to have. So if you have that, I want us to now move together. We prepare this together. So do you have that format with you? If you have that format with you, I think we can move together. Do you have that format? Do you have that format with you? 𝐉𝐎𝐻, type that in the chat box. Yes. So we have said we always start by recording what? The cash and cash equivalent at the start and also at the end. So can we do that? We go to where we have the current assets. In the statement of financial position, we determine how much was the cash and cash equivalent at the start and also at the end. I've said we consider a number of items: cash in hand, cash at bank, short-term investment. We go to where we have current liabilities. We see whether we have a bank overdraft. So under the current assets, so I can see we have short-term investment. That is the first thing we need to consider here, short-term investment. The short-term investment at the start. Remember, 2023 is the current year. These are the closing balances. 2022, these are opening balances. That is very important. So the short-term investment at the start is 50/40. So below that, we have cash in hand, which is 25/80. And then we go to where we have current liabilities down there. We check, do we have a bank overdraft? Yes or no? Yes, I can see we have a bank overdraft. The bank overdraft at the start, which is 2022, is 39,240. And in this case, I've said a bank overdraft. We take it here as a negative. We take it here as what? As a negative, because this is money which is owed to the bank. We get the net amount. That will give us a net amount of what? We have 50/40 plus 25/80 minus the overdraft, 39,240. What are you getting here? I'm getting negative 31,620. 620. Is that what you're getting? Yes. And that one is a negative. We do the same at the end of the year. So at the end of the year, we will take the short-term investment, which is basically 10 to 60. And then we take the cash in hand, which is basically 12. And then we less the overdraft, which is 14,340. 14,340, we get the net, and that is the cash and cash equivalent at the end. So 10 to 60 plus 12 minus 14,340. And that will give us negative what? Negative 28,810. Negative 28 what? 8. We already have two entries which are correct. Then we come back here and we start by recording a cash. That is not cash, rather the profit before what? The profit before tax. What is the profit before tax from the income statement? The profit before tax from the income statement, I hope you can see that, is the figure of 14,400. I hope you can see that. Then we make a number of adjustments to this profit. And the first adjustment we make to our profit, we said, is to add back the finance cost, or basically to add backward the interest. That is the first thing you need to remember, which is basically just above this. So, and I hope you can see that figure there, which is 25. Sasa, we add it back. Such that now we have what? We have the profit before interest and what? And tax. Then we have said to this, we need to, or we adjust that profit with the non-cash items. We just need to remember this acronym, the dial G. This stands for depreciation on property, plant, and equipment, PPE. This one stands for impairment loss. Impairment loss on goodwill. And basically this one stands for amortization. Amortization of intangible asset. Amortization of intangible asset is the decrease in value of intangible assets. And then this is loss on disposal. And then this one is the gain on what? On disposal. So we have said these past four items. This one, we add them to the profit, but this one we do what? We less. So on the face of the income statement, do we have any of those items on the face? Like the other question. On the face of the income statement, we don't have any of these items, but I can see investment income. Can you see the investment income? Yes. Investment income, basically, this is an income generated by the company from investment. So it is already included here. What we will do, we will less it from that profit. Why are we lessing it here? Is because this is not an income generated from operation. Generated from operation. So we let's set here the income, then bring it here. And basically, therefore, what you need to note from the other question which you have done, interest income received is the same with the investment income. Investment income is the same with what? Interest received. That's that? Yes. So you bring that here. It's an amount of how much? 15. So then from there, we don't have anything on the face of the income statement. Can we go to the additional information? Let's go to the additional information. In the additional information number 1, we are told the revaluation reserve relates to freehold land. So if you're given told revaluation reserve, these are components of equity. If you go to the balance sheet and the equity, you should be able to see that. But it's also important for you to note that if there was some asset, for example, which were revalued upward or downward, we don't consider that here because that is an non-cash item. So we are not even concerned with that. Let's go to note number 2. We are told depreciation on plant and machinery amounted to 6.9. Amounting to 6.9 was charged to the statement of profit or loss. In that case, we are given depreciation of 69. And remember, when taking any figure from the additional information, remember to omit the last 3 zeros because you can see our figures are in thousands. So we add it to this profit. Number 3, part of the long-term investment was sold during the year at a profit of 960. So in this case, we are told part of the investment was sold at a profit. We are only given the profit in this case. We are not given the sales profit. So what do we record here? 1, we will record that sale of investment. But remember, I've said what we record here are the proceeds. So how much amount was received from the sale of this investment? Are we given that? No. But what we are given is this. We are told there was a profit. A profit is the same with a gain. A profit on sale is the same with a gain. So the profit on the sale is the same with a gain. So there was a gain in this case of how much? Over 960. So that gain, this one we less it from that profit. But even before we move to the other point number 4, can we be able to know this investment which was sold? It was sold for an amount of how much? Can we go back to where we have non-current assets? Non-current assets. Non-current asset. How many assets do we have there? We have 3. Freehold land, plant and machinery, investment. Automatically, because investment was sold, the value for investment reduced. Can you see that? The investment at the start had a value of 22.5, and then that reduced to 21.6. Can you give me the reduction? Give me that reduction in the value for the investment. And then I will be able to explain how do we compute the sales profit. How do we compute the sales profit? So the value for investment reduced with what? The value for the investment reduced with what? The value for investment reduced with what? The value for investment reduced with 900. It basically means that this investment which was sold had a value of 900. They had a value of 900. The company sold the investment having a value of 900. This is the value for the investment. But by the end of the day, we are told the company made a profit of 960. So that is the profit, made the profit of 960, made the profit of 960. So in this case, can we be able to know our investment was sold at how much? If you have an asset having a value of 2 million, and then you sell it to make a profit of 1 million, you sold that asset at an amount of how much? You have an asset having a value of 2 million, but you sold it, you made a profit of 1 million. So you sold that asset at an amount of how much? That asset was sold at how much? Very simple. If you have an asset having a value of 2 million, you sell it to make a profit of 1 million. Automatically, you sell it at 3 million. The same concept you're using here. So this investment was sold at its value, 900, plus the profit. So this one was sold at 18.60. So that is a cash inflow because this money received from the sale of the investment. So let's go to note number 4. We are told during the year, the plant with a net book value of 4.5 was sold for 8,820,000, and then you're told it had an original cost of 18. So what we are interested with here is the amount which was received from the sale. Remember, anytime the company sell an asset, you consider here. We say there was a disposal. Disposal is the same with the sale of a plant. What do we consider here? We consider the proceeds. It was sold at how much? It was sold for 8,820,000. So that is the what? That is the proceeds. That is sales profit. Also, if you can be able to recall, we say that anytime the company sell an asset, you have to determine was the asset sold at a gain or at a loss. So we said, if you can be able to remember, my student for FA, we said you need to prepare a disposal account, though it's not a must. Once the company sell an asset, for you to determine whether it was sold at a profit or at a loss, just take the sales proceeds. Just take the sales proceeds. The asset was sold at an amount of how much? You less the net book value, which is also known as the carrying amount. In that case, we know that item was sold at 82. It's a 820. I hope you can be able to see up there, minus its net book value. We are not given the net book value, but basically, yes, we are given the net book value actually. The net book value is given, which is 4.5. 4.5. So you can see automatically that asset was sold at a profit. Because we said by applying this formula, if you get a positive figure is a profit or a gain. If you get a negative figure is a loss. Is a loss. So how much is the profit here? The profit in other terms known as the gain. The profit or the gain is how much? It's 820 minus 45. Yes, we have a profit of 43.20. So this is a profit, or in other terms, is a gain on the sale. Is a profit or is a gain on the sale of a plant. Now, that should also be captured here because you can see the company sold two assets. There was what? There was gain on both. So that gain, so remember this is a gain on sale of investment. And then we have gain on sale of plant. So the gain on sale of plant is 43.20. We also less it from our profit because in arriving at this profit, it was added, but it's a non-cash item. It's a non-cash item. So we are done with that point. Let's move to point number 5. We are told the following balances were extracted from the statement of changes in equity for the year which ended 30th of June 2023. So this is basically the change in the retained earnings. So we're given the retained earnings at the start, the profit after tax, the interim dividends which were paid, the final dividends which were proposed, and the balance. Now, from that information, what we are going to consider here is basically the interim dividends which were paid. If the company pays some dividends, and basically talk about the interim dividends, these are the dividends paid by the company in the middle of the financial year. If the year starts January, end in June, maybe the company in course of that year paid some dividends. That's basically what we consider here. So the dividends which were paid. That is basically 900. The dividends which were paid, the interim, but you can see we have other dividends which were proposed to be paid. So the proposed dividends were not yet paid. They were 27. But I think you have now to compute the final dividends which were paid. The final dividends which were paid. So how are we going to compute these final dividends which were paid? We are going to use the same concept which I've explained in the other question for computing the tax paid or for computing the interest paid. Now, if you go to where we have current liabilities, can you go to where we have current liabilities? Current liabilities. At the current liabilities, you'll be able to see proposed dividends at the start, at the end, in the balance sheet, at the current liabilities. So we are going to use the same concept we have used in the other question. In the other question. So yes, thank you for that. I'm told it is not that figure Morimo is speaking here. No, I hope maybe you're asking about this one. I hope you're asking about this one. Are you asking about this figure? Yeah, the gain? Yes, the gain should be a negative. And this one should be deducted from our profit. I hope you did the same for this. Any gain on the sale of asset has to be deducted from this. Because this one is already added here, but basically is a non-cash item. We do what? We less it. Sasa? Yes. Now let's come back here and we compute the final dividends which were paid. I'm saying we are going to use the same concept we have used in computing tax paid, interest paid. So what we do at the current liabilities, we will take the dividends which were proposed at the start. That is the year 2022, and they were 22.80. These are the proposed dividends the company was supposed to pay at the start. And then we add the proposed dividend for the current year, which we have in note number 5. The proposed dividend for the current year, they have a value of 27. So this will give us the total dividend the company was supposed to pay during the current year. And then we less the dividends which were not yet paid at the end. The dividends not yet paid at the end, you can see they have a value of 27. So can we be able to determine the dividends which were paid? Yes. So it will basically be this one. 22 what? 2280. We record it as a negative. So, and I think we are done with the notes. Having finished with the notes, then we come down here and we consider what? The changes in working capital. Never forget to get these 3 marks. Changes in working what? Capital. Because here we have said these are just 3 marks. These are just 3 what? 3 months. So here we just need to recall the acronym, that is RIP, not less in peace, but receivables, inventory, and payables. The receivables, inventory, and what? And payables. So how do we deal with these 3 items? We just need to determine whether there was an increase or decrease. And then we determine is that increase or decrease an inflow or outflow. So I've said just use this formula. Opening minus closing, opening minus closing, and then this one closing minus opening. As simple as that. As simple as that. As simple as that. Juma, I've said the computation of this, we are using the same concept. If you have understood how we have computed the tax paid in the previous question, we are using the same concept. You see, the proposed dividend are the dividends, the proposed dividend are the current liabilities. Those are the dividends which were not paid at the start and also at the end. The proposed dividends we have in note number 5 are the dividends the company was supposed to pay during the current year. So how do you compute the actual dividends which were paid during the current year? You take the dividends the company was supposed to pay at the start, add what the company was supposed to pay during the current year, and then compare that with the dividends not yet paid at the end. Automatically, the difference represents the dividends which were paid during the current year. And that is basically the same concept used in the computation of tax, in the computation of interest. That's that? Yes, the same concept. If you understand that, that will save you for 3 items: the tax paid, interest paid, and the proposed dividend. That's that? Yes. So let's deal with these 3 items. We are going to go to where we have the statement of financial position, and we start by picking receivables. So not receivable, rather, let's start with the inventory. We take opening minus closing. The opening is the figure we have in the statement of financial position for 2022. That is 200 minus closing 40, 300. And I'm getting negative 81. Negative 81. I hope that is what you're getting. That is for inventory, not receivables. Inventory. Inventory here. Yes. So I'll do the same. We need to do the same for receivables. For receivables, we take the opening, which is 46,800, minus closing, which is 36,840. What are you getting? I'm given by Evans 9960. Basically, which is a positive, is a cash inflow. Then we have said you also need to check whether you have other receivables or prepayment. Do we have other receivables or prepayment? No. We go down there where we have the current liabilities. Under the current liabilities, we only consider one item: account payable. Account payable, we use this formula: closing minus opening. Closing minus opening. So the closing is 35,100 minus opening, which is 31,500. And basically that will give us what? That will give us 36, which is a positive. Which is what? A positive, which is a positive. And then from there, we proceed and determine 2 other items. We proceed and determine 2 other items. 1, we less the tax paid, and then we also less the interest or the finance costs paid. So we can start with the tax. Tax, we are using the same concept we have used in the other question. So we go to the income statement, how much is the tax for the current year, and the statement of financial position at the current liabilities. So can we first of all go to where we have current liabilities in our statement of financial position? And we consider whether we have tax. Yes, and we have tax. The tax which was not yet paid at the start is 36. And then to this, we add the tax in the income statement. I hope you can see the tax in the income statement, 54. And then we minus, just the way we have computed the dividends which were paid, using the same concept, minus the tax not yet paid at the end, which is 49.20. So the tax in the income statement is 54. Tax at the start is this one. Yes, so that will give us tax paid of how much? Yes, 48. So we do the same for interest. For interest, you just need to go to where we have current liabilities. You check, do we have any accrued interest under the current liabilities? No. If that is the case, it basically means that the interest paid is what we have in the income statement here. But if we had any accrued interest under the current liabilities, we use the same concept. Take accrued interest at the start plus the interest or the finance cost from the income statement minus the accrued interest at the end, which will give us what? That amount. We are done then. So don't even bother yourself adding anything. Let's come here. I think here majorly we have dealt with most of the items because we are given the asset which were acquired, the asset which were purchased. Can we go to the equity and non-current liabilities in our statement of financial position? At the equity, first of all, I can see share capital. The share capital at the start was 90,000. It increased all the way to 108. What causes the share capital to increase? The share capital increases because our company issued shares. So we will come here and we say that there were shares which were issued. The shares which were issued will automatically be equal to the increase. 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 How much is the increase here? The increase is 18,000. So the shares which were issued by our company, they had a value of 18,000. 18,000, which is a cash inflow. Below that, what do we have? We have share premium. Share premium, did it increase? Yes. What causes the share premium to increase? The share premium basically increases because these shares which were issued, they were issued at a premium. That increase in the share premium represents the money which was received by the company in form of share premium. So you will also come here and you say there was increase in what? In share premium. And basically in this case, the share premium increased with how much? The share premium increased with 45. That also represents money which was received by the company, but in form of what? In form of premium. In form of premium. We are done with that. So below that, we have revaluation reserve. Do we consider that here? No. Revaluation reserve, this changes as a result of revaluation of assets. Once the company revalue assets, either upward or downwards, that is a non-cash item. We don't consider that here. Below that, the retained earnings, mostly that is used in the computation of dividends which were paid, but I think you already have that. Then we go to where we have 10% loan. 10% loan at the start, 32. At the end, that loan reduced. What causes a reduction in the value for the loan? What will make the loan to reduce from 34 million to 25 million? What causes the loan to reduce? What causes the loan to reduce? Who can tell us here? What causes the loan to reduce? The loan will reduce because of repayment. The loan reduces because of repayment. So we come here and we say there was repayment. There was a repayment of 10% loan. There was a repayment of 10% what? Loan. So how much was the repayment? Which is basically equal to the decrease. Which is equal to the decrease. Which is equal to the decrease. Is it 9? Is it 9,000? Is it 9,000? Yes. And automatically, the moment the company repays a loan, that involves what? Cash outflow. So if you have taken a loan from the bank, you repay back that loan. That involves cash what? Outflow. That involves cash outflow. That question you debate at that point. Don't even bother yourself adding the totals here. Don't. That is pure wastage of time. The person who is marking your paper will come and check these entries. Will come and check these what? These entries. These entries. These are the entries basically which will earn you marks. These are the entries which will earn you what? Will earn you marks. And I hope you can see in our case, have we done any working here? Have we done any working? No. You can see all the workings which you are doing. We are doing them inside the bracket here. That will save you a lot of time. Will save you a lot of time. By using this particular approach, number one, I've said you'll be able to finish the question within the time you have, because I've said for you to handle this question, never make a mistake of taking more than 40 minutes. Maybe these questions computation, you can give yourself 40 minutes, because most will come across a theory question. Maybe the time you're taking to do a theory question, maybe you can just reduce it, maybe like to 20 minutes, such that this computation don't take more than 40 minutes. If you take more than 40 minutes, then that is a disaster. That is what? A disaster, because you'll not be having time to handle the other questions. So just pick those low-hanging fruit, those 3 marks, which basically you can be able to get without a lot of struggle, without so many workings. And actually, you can see this question, even if, for example, this is how the question was marked, any 14 ticks at 1, you will see we already have all the 14 marks. All the 14 what? Marks. Because even if you count the number of ticks 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So we already have all the marks with us. Yes. So that approach, which I've showed you, very, very important. So as you practice, so can you use that approach? Make use of that particular approach. Basically, this will help you in terms of passing any question for cash flow. The other thing you also need to understand is where do you get 3 marks, or basically what in other terms we refer to as low-hanging fruit. I've said there are those marks which are free. Like here, changes in working capital. Make sure you get those marks. Probably you can be able to remember it, and these formulas I've given there: opening minus closing, payable closing minus opening. Then here you can be able to remember this acronym, dial G. Then here you also need to remember that the items we consider here come from equity and current liability. So if you're able to do that, these are questions. Once you come across this question, be assured you'll be able to pass. And basically, like for those who are doing a CPA foundation level, so I'm expecting that this is one of the questions you're likely to come across. This is one of the questions I'm expecting it will be examined. It will be what? Examined. If you check last teaching, there was no question on this. So can you do a lot of practice? Can you do a lot of practice? A lot of what? Practice as far as that is concerned. And then there was that other part, part B, comment on how Biashara Limited has generated and used its cash from cash and cash equivalent for the year. Now, basically, for you to be able to do to make that comment, you have to get these net cash flows. For example, you get the net cash flows from operating, the net cash flow from investing, and then the net cash flow from what? Financing. You must get those particular net amount. So once you get those net amount, then you need to make a general comment. If, for example, here you get a positive figure, here you get a negative figure, and here you get maybe also a positive figure, the first thing you say is that this company generated cash, 1, from operating activities because we have a positive there, and also from investing, from financing activities because we have a positive amount there. And then you say much of the cash generated by the company was spent or was utilized by the investing activities, because here we have what? We have a negative. We have what? A negative. Other than making that comment that the company generated cash through operating and financing activities, and the company spent cash through investing activities, you can then be more specific, and you say that much of the money which was spent by the company, or maybe much of the money which was generated by the company from investing, from financing activities, it was generated from the issue of shares, because you can see here the company was able to raise a lot of money from the issue of shares. And here you can also be able to say that the company generated a lot of cash from investing activities by selling assets. By selling what? By selling assets. That is the comment. That is basically what you are expected to comment on. First of all, you must get the net cash flows from the 3 activities, and then make a general comment on which activities generated cash, which activities utilized the cash, and then you can also be more specific. You can be more what? More specific. More what? Specific. But what I want you to understand is basically how to handle this question for cash flows, particularly in what? In an exam. In an exam, because majority of the students basically understand how to prepare statement for cash flow, but basically they lack that particular knowledge of doing these particular questions in an exam. Because remember, you don't have all the time with you. You have just 40 minutes, less than 40 minutes to do what? To handle this question. You must be having a strategy on how to do the question within 40 minutes and also how to get those 3 marks. That is very, very important. Very, very what? Important. Yes, so I'm told in this case, in case someone leaves a big space in between the 3 headings, will it be, no, basically no, that will not have any problem. But basically by then, by the end of the day, once you do a lot of practice, you should be able to know the space to leave here. So once you do a number of questions, you'll be able to see the space you need to leave here. Because I don't think you should leave more than half a page. More than half a page. More than half a page. Yes, more than half a page. Or maybe a 3/4, more than 3/4 of the page. Because this basically where we have so many items, as you can see in the 2 questions we have done. Yes. So what I want you to do, I want you to pick other questions, maybe from the past papers. Those who are doing FR, we have so many questions on this from your papers. Those who are doing FA, foundation level, so many questions on this. Also, those maybe who are doing AFR, this is also a knowledge you need to have. Even if now the question for AFR, they have additional concept. The aspect of acquisition of subsidiary, disposal of what? Of subsidiary and so on. But this knowledge is basically important to all. The shortcut, how to get those row hanging what? Row hanging or those basically those particular free marks. Yes. So basically for today, I want us we stop at that particular point. I want us we stop at that particular point. We continue from there in our next class. We will basically be inviting you for 3 sessions because I know some of the topics, like in a PAL, in a FA, some topics may be the same, like ratios. Ratios are in FA, ratios are in a PAL, ratios are in the BDA, those who are doing BDA. So basically once maybe Marimo is revising a common area, I will basically be inviting you to attend these sessions. So equally remember, I've said that we started, actually our blocks started, our revision started today. If you know someone who is preparing for the August 2025 exams, and he needs some revision, you can talk to him or her basically to join us. I've said currently we have an early discount which will be expiring tomorrow. We are charging 1,500 for all units for CPA, CFA and also ATD. But those who are doing BDA, we have an early discount of 2,000. So that discount, that early discount will be expiring tomorrow. So maybe you can talk to your colleagues and basically join our ongoing revision classes. So let's stop at that point for today. See you tomorrow as we continue with our revision. And that is for those who are doing FR. We have a class tomorrow. What we are paid on a Friday. What we are BDA, I think we have a class after this. Those who are doing AFR, see you tomorrow. So have a good night. Method, we take the profit before interest and tax, and usually we adjust it with 3 items. The non-cash items, which were added or deducted in arriving at net profit. Number 2, the changes in working capital, basically where we consider 3 items of working capital, receivable, inventory, and payables. And also we adjust that profit with any investing or financing activity item which was added or deducted in arriving at net profit. So basically, I think that is the first thing you need to remember as far as the statement of cash flows is concerned. And I think with that particular quick recap, I want us to go straight to a question. And there is a question which has already been shared in the class chat box, maybe for those who are joining us right now. So there is a question which has already been shared in the chat box. So if you can be able to see that question, please confirm that is the question you want us to do. Can you be able to see that question, those who are just joining? If you can be able to see that question, please confirm that is the question I want us to do. Can you see that question in the chat box? Can you see that question in the chat box? I want us to use the question from CPA foundation level. CPA foundation level. That is the question 4B of August 2024. Yes, so can someone reshare that question afresh? Evans, please reshare that question afresh. Reshare that question afresh. Reshare the question afresh. Yes, so I think it has already been reshared there. It has already been shared here. So let's go through it. We see what we are told and equally what the examiner was requiring here. So the question reads, part B, question 4B, it reads, the following are the financial statement of Precious Limited for the year which ended 31st of March 2023 and 31st of March 2024. So we're given Precious Limited statement of profit or loss, which is for the year which ended 31st of March 2024. We have the gross profit operating expenses. We have other incomes which include interest income received, the gain on sale of investment, and then we have the loss on sale of plant. And then from there we have the interest paid, the interest expense which was paid, and then we have the net profit before tax. We have the income tax for that year, and then we have the net profit after tax. So then from there we have the statement of financial position. We are given statement of financial position basically for 2 years, 2023 and 2024. It is important for you to note that anytime you come across a question for cash flow, always the examiner will give you the statement of profit or loss for the current year. And then for the statement of financial position, that is basically the balance sheet, you'll be given the statement of financial position for the current year. For example, in a case, the current year is the year 2024, and for the previous year. So what you need to note is that the figures which are given here in the statement of financial position of the previous year, 2023, these are treated as the opening balances, whereas the figure we have here in the statement of financial position for 2024, those are closing balances. That's basically what you need to know. So we have the non-current assets, which include PPE, property, plant, and equipment, at cost and also accumulated depreciation. We have the investment, we have the current asset, which include inventory, account receivable, cash, prepayment, and then we have the total current asset and the total asset. And then we have liabilities and capital, where we have ordinary share capital, revenue reserve. Revenue reserve, this is another name for the retained profit, or is basically another name for the retained what? Earnings. Then from there, we have the long-term liabilities, which include bonds. We have the current liabilities, which include account payable, accrued liabilities. And then we have tax payable. And then we have the current liabilities, total equity and liabilities. Then we have additional information, number 1, all the way to note number 7. So what then are we required to do here? We're required to prepare a statement of cash flows, which is for the year which ended 31st of March 2024, in accordance with the International Accounting Standard number 7, which governs the preparation of the statement of cash flows. Now, in this case, number 1, recall what we have said. There are 2 methods which are used in preparation of cash flow. We have direct method, we have indirect method. But if you check on this particular question, the examiner has not specified which method we need to use, whether we use the direct method or basically whether we use what? We use the indirect method. But anytime you come across a question for cash flow, you are given the income statement or the statement of profit or loss, statement of financial position. If the examiner is not specific on which method to be used, always use the indirect method. So the indirect method basically has so many free marks when it comes to computation of the cash flow from operating activities. So that is the first thing you need to do. The other thing, assuming this is a question you are doing in an examination setup, it is not advisable to start with the workings, because this where or what make majority of the students to fail in these particular questions. So how do you get free marks, or basically what you refer as the low-hanging fruits? So basically what you need to do is that once you come across a question for cash flow, number one, never start with the workings. Just go straight to what the examiner is requiring you to prepare, because the 16 marks which are allocated here, they are allocated for preparing a statement of cash flow. So if you do all the workings, they are correct. By the end of the day, you fail to prepare the statement of cash flow, you will get 0. So therefore, what you do, go straight to preparing what is required. Basically, any working which you do it per need basis. You are doing a working to determine an item to be posted in the statement of cash flow. So therefore, what we do, we go straight to preparing what is required. And actually, we need first of all to have the title. So the name of this company is Precious Limited. Precious Limited. And basically, this is the statement of cash flows. The statement of cash flows. And basically for the year, which ended 31st of March 2024. 31st of March 2024. Obviously, you must have the title. You must have the title of what you're preparing. And then from there, you need also to remember, in preparing this particular statement of cash flows, we have to determine net cash flow from 3 activities. So can you have those particular 3 subheadings? So basically, always, we start by determining the cash flows from operating activities. That's basically what we know. We start by determining the cash flows from operating activities. So here we need to have 2 columns, and I hope you can be able to see that if you go back to that question, all our figures are given. The figures in the income statement or the statement of profit or loss, the figures in the statement of financial position, they are given in thousands of shillings. So you need to have 2 columns here like that. So then from there, you leave some enough space here, because when computing the cash flow from operating activities, we have so many items which we record here. So leave enough space. And then from there, you have the other subheading for basically determining the cash flow from what? The cash flow from investing activities. And basically, remember, in this case, we have said investing activities are those activities which involve acquiring assets and also selling assets. So what we record here are the assets which were acquired, the assets which were purchased, and the assets which were sold. So we don't have so many items which we record here. Leave just enough space, not a big one. And then from there, we have the other subheading for determining the cash flow from the financing activities. And actually, all the items which we record here, we get them from equity and basically the non-current liability section of the statement of financial position. All the items which we record here, we get them from the balance sheet, specifically at the equity and non-current liabilities. And then down here, we come and we record something known as the cash and cash equivalent. This is cash and cash equivalent, a balance, a brought down, and also we record the cash and cash equivalent, a balance carried what? Balance carried down. Balance carried what? Balance carried down. That's the first thing you need to have anytime you come across this particular question for what? For cash flow. Anytime you come across this particular question for cash flow. And then having that now, I want we proceed and we look on how then do you get the low-hanging fruits. So there are the low-hanging fruits. Remember, we have said that these are the free marks. These are the marks basically you get without any working, any working. So basically, the first thing I advise my student to record is this: cash and cash equivalent at the start and also at the end of the year. So what do you mean by cash? Cash, basically, you can be able to record, this is cash in hand, cash at bank overdraft, and then cash equivalent. These are the short-term investments. The short-term what? Investment. So basically what we need to do is we go to our statement of financial position under the current assets. We check whether we have cash in hand, cash at bank, short-term investment, and then still we will go to where we have current liabilities. We check whether we have a bank overdraft. So can we do that? The first thing, we go to the statement of financial position, specifically under the current asset. So under the current asset, can you tell me which item of cash and cash equivalent do we have there? Which item of cash and cash equivalent do we have under the current assets? So tell me which item of cash and cash equivalent we have there. Which item of cash And cash equivalent, do we have? Do we have under the current assets? Type it in the chat box. Yes, I'm told the first one is basically cash. Is actually what? Cash. You also check, do we have bank balance? No, we don't have bank balance. Do we have any short-term investment there? No. So therefore, and remember what we have said that we are given statement of financial position for 2 years, 2023, 2024. So the balances we have here, these are opening balances. In other terms, these are what we refer to as the brought down. The brought what? Down. Whatever we have here, these are closing balances. This is what we refer to as the current what? Down. That is also very, very important. Very, very important. So therefore, what we have is cash. So what we do, we take cash, and basically the cash, we take cash at the start from the statement of financial position for 2023, and I hope you can see that is a figure of 2250. 2250. And then from there, we go to where we have the current liabilities. We check, do we have a bank overdraft? So under the current liabilities, do we have a bank overdraft? Yes or no? Do we have a bank overdraft? Yes or no? Under the current liabilities. Do we have a bank overdraft? No. So but if we had a bank overdraft is basically money which is owed to the bank. We come and we raise it here. So therefore, the cash and cash equivalent at the stand is how much? Is 2250. So we do the same. We do the same at the end of the year. So by now we know that we only have one component of cash and cash equivalent, and that is basically cash. So what we will do, we will take the cash and cash, the cash balance at the end of the year, and basically that is an amount of how much? That is an amount of 69. That is an amount of what? Of 69. Yes, someone can, someone to share that question, in the chat box. Someone to share that question in the chat box. Someone to share that question in the chat box, please. Someone to share that question. Someone to share that question in the chat box. Okay, it has already been shared, Janet, there. I hope you have seen it. Yes, so that is the first thing you record. And in most of the cases, what is important for you to note, what is marked in these particular questions are the entries. Are what? The entries. And basically, mostly this particular question for cash flows, how are they marked? This is how these particular questions are marked. So like you can see the marks are located here were 16. So mostly these particular questions will be marked like this. Any 8 correct items here, you are given 2 marks. So mean that if you get 8 correct entries here, you'll get 16. Alternatively, if the question has so many entries, the question can be marked like this. Any 16 entries at 1 mark, and basically you get what? The 16 mark. So it depends with the number of entries. So if a question do not have so many entries, it can be marked like that. If the question has so many entries, it will be marked like that. So therefore, what is important here is not by the end of the day to do so many workings here. What is important when preparing a statement of cash flow are the correct entries you make here. Are the correct entries you make what? In the statement of cash flow. For example, those 2 correct entries, those 2 entries, they are correct. Those are already 2 ticks. Yes, after doing that, then we come back here to where we compute the statement of, or actually we compute the cash flows from operating activities. And remember, in this case, I've said here, we are preparing this particular statement of cash flows using the indirect method. So under the indirect method, we compute these particular cash flows by starting here, or here we start with the profit before what? Before tax. When computing this, we start with the profit before tax. Where do we get the profit from before tax? We get this from the income statement. Can we go to the income statement? You give me the profit before tax. How much is the profit before tax from the income statement? How much is the profit before tax from the income statement? So in our case, it is referred as net profit before tax. Net profit before tax. Can you see that one? Net profit before tax? Yes. So the net profit before tax is basically an amount of 450. But if you can be able to recall, we said in computing this particular cash flow from operating activities, we should start with the profit before interest and tax. In other terms, what is known as the operating profit. But if you check, in our case, we don't have that operating profit. So therefore, what we say is that to this particular profit here, the first adjustment which we make or the first adjustment to this profit is basically to add back the finance cost, which is also known as the interest expense. The interest expense, and actually this interest expense is always above that profit. Is always above that profit. So can you see that figure of the interest expense? Yes, the interest expense is the same. That is an amount of what? 34.50. And actually now that will give us the profit before interest and tax. And then from there we say to this particular profit, we need to make a number of adjustments. The first adjustment we make to this profit is basically to adjust it with the non-cash items. We say the non-cash item, for you to be able to remember the non-cash item to be adjusted to this profit, just remember that acronym. The acronym is 𝐷𝐿G, 𝐷𝐿G. So this stands for what? This stands for depreciation. This stands for depreciation on property, plant, and equipment. This one stands for impairment loss. Impairment loss on goodwill. Impairment loss on goodwill. A stands for amortization. Amortization of intangible assets. Amortization of intangible assets. Then this one stands for loss on disposal. Loss on disposal. So the loss on disposal is basically whereby the company disposed or sold some assets during the current year, and basically the asset was sold at a loss. It was sold at what? At a loss. And this one is basically stands for gain on disposal. This one stands for gain on what? On disposal. So therefore, what we need to do, we need to go to the additional information. But I think even before you go to the additional information, because most of these items will be given in the additional information, on the face of the income statement, there are a number of items we need to adjust to these. We need to adjust to this profit. So can we go back to the income statement or the statement of profit or loss, and specifically whereby we are given other incomes? Specifically whereby we are given other incomes. So where we are given other incomes, number one, we are given something called the interest income received. Now, interest income received, is that an income from operation? That is the first thing you need to ask yourself, because what we want to determine here is the cash which was generated from operating activities. Now, anytime you're given an interest received, a company receives interest as a result of having invested. So therefore, what you do, because that interest has already been included here, you come here and you less it. So first of all, we can skip all these items, and then we take the interest which was received, interest income which was received, interest income which was received, which has already been added in this profit. So the reason why we are raising this is because this is not an income from operation. So this is an income generated by the company from what? Investing. So you raise it from that profit, and then you come and include it here. So that is the interest income which was received. And remember, this is money which was received. So when recording it here, you record it as a positive. So why are you recording it there as a positive? It is because it is cash which was received, is an inflow. But here we're recording it as a negative. Why? Because we want to eliminate it here from this profit. It is included there, but it's not income from operating activity. So you less it here, and then you bring it there. That is the first item. Then still under the other income, we have the gain on sale of investment. So the gain on the sale of investment. So anytime the company sells an asset, be it an item of PPE, and that item is sold at a gain, so that gain is usually accounted for as an income, but basically we say that is a non-cash item. That is a non-cash item. So take into account it is included there. What do? Place it down there. Then also below that, the gain on the sale of investment, we have the loss on sale. We have this. So the loss. So the loss, basically this is 450. You can see the loss in arriving at this particular profit, it has been deducted. It was accounted for as an expense. So, and because this is a non-cash item, what we need to do, we need to add it back. Actually, these non-cash items, basically which we have here, depreciation, impairment loss, amortization, and the loss on disposal, because in arriving at this profit, they had been deducted, what you do, you add them back. But now this gain, you do what? You less it. That's basically what you need to remember. Yes. So you can see that all these are free marks. All these are free marks. This is basically what we refer to as low-hanging fruits. These are basically marks which you're able to get in this particular question without any struggle. Without any what? A struggle. You can see so far we have not done any working, but we have so many entries here. Yes. Now, having said, I think we need to go to the additional information because we don't have anything else we can be able to pick from the statement of profit or loss. Let's go to the income statement. Not the income statement, in the additional information. In the additional information number 1, we are told Precious Limited purchased investment worth 11.7 million during the current year. So this company purchased investment. So if a company purchased investment, remember is a form of an asset. And that's why if we go back to our statement of financial position, specifically where we have the non-current asset, you'll be able to see we have the property, plant, and equipment. We have accumulated depreciation. Below that, we have investment. So we have said those particular activities which involve acquiring and disposing assets, they are what? Investing activities. So that purchase of investment, you come and you record it here. Purchase of what? Purchase of investment. Purchase of investment. So the investment which were purchased were 11.7. And I hope you can be able to remember, in all the figures we are given in the income statement of financial position, the last 3 zeros are omitted. So anytime you're taking a figure from the additional information, you must do the same, omit the last 3 zeros. Then you also need to remember our rule here. When preparing the statement of cash flows, we have said this rule is very, very important. This rule is very, very important, that any amount which is a cash inflow, we record it here as a positive. Any amount which is a cash outflow, we record it in our statement of cash flow as what? As a negative. So now who can tell us this particular amount here? Once the company purchased an investment, is that an inflow? That particular amount there, is it an inflow or outflow? The company purchased an asset. Is that an inflow or basically outflow? Inflow or outflow? Who can tell us? Inflow or outflow? Yes, automatically this one is outflow. This one is what? Is outflow. So take into account as an outflow. We record it here as a negative. Don't forget, if you record it here as a positive figure, it is wrong because the person is marking will only give you mark if it is recorded as an outflow. We are done with that. Let's move to note number 2. We are told the company sold a new investment that had cost 13.5 for 15.3 million. So we have sale of investment. So remember what we consider here is asset which were acquired, asset which was sold. So in that case, we can say there was sale of investment. There was sale of investment. And basically, once the company sells an asset, what do we consider here? What do we consider here is the proceeds. When talk about the proceeds, this is the money you receive after selling an asset. If you sell an asset, how much cash do you receive? So in that case, we are told in note 2, that investment had a cost of 13.5. It was sold for 15.3. How much cash was received in that case? Is it 13.5? Is it 15.3? How much cash was received? Who can tell us here? The cash inflow, the sales proceeds, that basically what we consider here. Yes, I'm told by Evans that the cash received here is 15.3. 15.3. Eunice? Yes, that is very much correct. 15.3. And then 15.3, this is an inflow. When you sell an asset, you receive money. You sell an asset, you receive what? You receive money. You receive money. Yes. So basically, that is it. That's what we need to recognize there. So we are done with that. Let's move to note number 3. We are told during the year, a new machinery worth 18 million was acquired. Was what? Acquired. That is also another free entry here. So the company acquired a machine. So once the company acquired a machine, that is still an investing activity. So we say there was acquisition of what? Of a machine. There was acquisition of a machine. You can see the number of entries we have in our statement of cash flows, yet we have not done any working. Have we done any working, Kelvin, here? Have we done any working, Eunice? Have we done any working, Evans? We have not done it. And you can see the number of entries which we have. So because I've said what is marked in these particular questions are these entries. That's not. This is basically what we refer to as the low-hanging fruits. This basically marks you get without a lot of struggle. So then you are told in the same point number 3, sentence 2, some item of property, plant, and equipment had a cost of 1.5 and accumulated depreciation of 300,000 were disposed for 750. So many free marks here. So we have disposal. Disposal, remember, is the same with the sale. Is the same with the sale of an item of PPE. What do we consider here? What we consider here is the proceeds. So that item of PPE which was disposed, we are told it was disposed for how much? Can you see the sales proceeds here? So that item which was disposed, was it disposed at 1.5, 300 or 750,000? It was disposed for how much? What is the sales proceeds? That is basically what we consider here. Yes, the amount which we consider here is 750. The sales what? The sales proceeds. So basically we are done with that point. Let's move to point number 3. Point number 4. We are told included in the operating expenses for the year which ended 31st of March 2024 is depreciation charged, and the depreciation charge for the year which amounted to 5,550,000. So in our case, we come back here, we are given this depreciation, which is 5,550,000. That is another free entry. So, and we said that this is a non-cash item. It was deducted in this profit, we add it back. That's why we say this part, these 4 items there, we add them to the profit. So we are done with that. So we move to point number 5. We are told the company issued bonds worth 15 million at a face value in exchange of a current asset on 31st of March 2024 and repaid bonds worth 7.5 at the face value, at the face what value. Now in that case, we are given 2 transactions in 1.1. We are told the company issued bonds. Bonds are basically the same with the debentures. So bonds are the same with the debentures. So means that if you go to the balance sheet, to the statement of financial position and the non-current liabilities, you should be able to see bonds there. And I hope you can see that in our statement of financial position and the non-current liabilities, we have both. Bonds are basically the same with debentures. We are told that there were some bonds which had a value of 15 million, which were issued in exchange of a current. Let me first of all ask, is this, or do we have any movement of cash there? The moment the company issued bonds in exchange of an asset, do we have any inflow or outflow to the company? Do we have money flowing in or money flowing out? You issue bonds, you receive an asset. You issue bonds, you receive an asset. Is there any movement of cash there? There is no movement of cash. So therefore, what is important to note is that when preparing a statement of cash flow, actually from our definition, I said, it is prepared to show the sources of cash and the application of that cash. How was the cash generated by the company utilized? So therefore, in preparing a statement of cash flow, any transaction which does not involve movement of cash, any transaction which does not give rise to cash outflow or cash inflow, we don't consider it here. Sasa, yes, like that transaction will not be considered here. It's a non-cash item. But also on the same point, you are told the company repaid bonds. So when talk about repaying bonds, you see bonds are issued by the company for the company to borrow money. So the company usually will have agreed with those who will buy bonds that they will be given back their money after a number of years. For example, the company can issue bonds having a life of 5 years. So meaning that the holders of the bonds will be given back their money. In other terms, the company will pay back those particular bonds at the end of the 5th year. So once the company repays bonds, that is a cash outflow. And where do we consider that? We consider that here. That's why we said all the items which you record here, we get them from equity, non-current liabilities. We know both are part of the non-current liabilities. So here we will come and we say there was a repayment of both. There was a repayment of both, basically which had a value of 7.5. And this is cash outflow. The moment the company repay back the bonds, which had been issued, that involve cash outflow. So we are done with that point. So let's move to point number 6. And you're told the company issued 2.25 million ordinary shares of shillings 10 per, basically per value. So where do we consider this? This one is considered here. And basically, can you go to where we have, because that basically affected the share capital. Let's go to where we have share capital. And basically in that case, you can see the share capital increased from, because remember in our case, we are given a statement of financial position for 2023. I've said these are opening balances. And 2024, basically, which you have said are closing balances. So you can see the ordinary share capital at the start was 47 to 50. And then at the end of the year, the share capital increased. So the reason why we have an increase in share capital is because the company issued shares. So who can tell us how much is the increase here? The increase is how much? The increase, that increase in share capital is, I'm told by Evans, is 22,500. So basically, as per point number 6, we are told this increase was due to issue of how many shares? The company issued 2250 ordinary shares, each share having a value of 10. So if you multiply this, the value of each share with this one, you'll see that will automatically give us that amount. So when the company issues shares, that one is considered here is a financing activity. The company issue a share to do what? To raise finances. So we say there was issue of ordinary shares. So how much amount was received? 22.5. So an amount received by the company is a cash what? Inflow. So we consider that here. We consider that here. Yes, we consider that there. So then after that, we move to the last point. Number 7, the company paid cash dividends of 1.2. This was a very, very simple question. Almost everything is provided. So once the company paid dividends, those dividends paid are recorded here. So we say cash dividends paid. Cash dividends which were paid how much? 1.2. So the moment the company paid dividends, that is a cash outflow. That is a cash outflow recorded here as a negative. Recorded there as what? As a negative. Are we done with the notes? Yes. Can you see the number of entries we have here? Even if, for example, the question was marked like this, because this one automatically, you can see it has so many entries. So automatically, for every 16 ticks, 16 correct entries, you get a mark for each. And basically, by the end of the day, you get how many marks? 16. Can you see the number of entries we have? Basically, we have not done any working, but you can see the number of entries we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. If you decide to read that question like that, you'll be having all the marks. You'll be having all the marks. And basically, that's a question which you should be able to do within not even more than 30 minutes. Because the other thing, maybe for those who are doing the CASNEB exam for the first time, so you'll come across a question with 5 marks. 5 questions. You're given 3 hours. So if you take 3 hours times 3 hours times 60, that basically comes to a total of 180 minutes. 180 minutes. So this basically to handle how many questions? 5. So if you take 180, you divide with 5, basically this will give you 36. So it basically means that this question should not take more than 36 minutes. More than 36 minutes. That's why it's basically important for you to know the approach to use, because if by the end of the day you start with doing the workings and then later on you prepare this, you'll spend a lot of time. So you may see that you're spending one full hour to do one question. And basically, remember, you have 4 other questions. So that's why it's very, very important for you to be able to know the approach to use in doing these questions in an exam. Other than knowing the approach, number 2, you should also be able to know how to harvest the low-hanging fruits, how to get the free marks. The free what? The free marks. Now, after doing that, there are other free marks here you should always get. You should get down here. And basically, that is in relation to the changes in working capital. These are also free marks. Changes in working capital. Now, here, remember we consider majorly 3 items. 3 items. And for you to be able to remember the items we consider here, just recall that acronym. Just recall that word. Just recall this acronym here. RIP, receivables, inventory, and what? And payables. That is basically what we do, what we consider here. So Juma is asking, so workings don't carry any single mark. No, Juma, workings do not carry any single mark. In fact, having marked these papers for a number of sittings, I know those who mark, the moment you start with the workings, you just put cross line like that. So if you, for example, you have the first page and the second one is working, just a cross line like that. So the person who is marking this question for you will be checking, did you prepare the statement of cash flow? And now, if you prepared this, he will come and check these correct entries. So that's where the marks are. Never start with workings. Those workings, by the end of the day, they do not earn you any marks. They just consume a lot of your time. And I've said any working you are doing, here, do it per need basis. You are computing an item to be posted here. Don't compute something which is not required to be posted here. Do all the workings per need what basis. Because knowing that approach, Juma, is very, very important. It will save you a lot. It will save you a lot. Yes. Let's come back here now. Let's come back here. I want us to still do another question like this. So here we consider 3 items: receivable, inventory, and payables. So receivables, inventory, and payables. But basically I've said, remember this acronym. Not less in piece, but this one stands for the receivables, inventory, and what? And payables. Now, what we need to do basically here is to do what? Is to determine whether there was an increase or decrease as far as these 3 items are concerned. Now, to make it very simple, here there is a formula I give my students. So here we take this. I'll be able to explain what you mean by that. O minus C. And then here C minus O. Yes. So just remember that. O minus C, O minus C, C minus O. So what is this? This is opening balance minus closing. Opening balance minus closing. Closing balance minus opening. So you apply that formula. Whatever you get by applying that formula, if it is a negative, you record it as a negative. Whatever you get by applying that formula, if it is a positive, you record it as what? As a positive. Yes. So we start with we go to where we have our statement of financial position under the current asset. We know inventory and receivables is part of the current asset. So can we start with the first item? And that is the inventory. So we will take the opening, which is 16.5 minus the closing. Opening minus closing. 16.5, which is the opening, minus closing, which is 21.6. 21.6. What do we get? What are we getting here, Eunice? Yes, we are getting negative 51. So record it as a negative. That is an outflow. That is what? An outflow. And basically that is inventory. That is what? Inventory. That is the inventory. That is the inventory. And then from there, we do the same. We do the same for receivables. Receivables, we do the same. Opening minus closing, 82.50 minus 70.50. So we get positive what? Positive 21. Positive 21. So we have that. But now, before we move to receivables, to payables, I hope you can also be able to see under the current asset. Below cash, can you see we have prepayments? Can you see we have prepayments? Yes. Now, prepayment is basically part of receivables. It's part of what? Receivables. So in case under the current asset, in most of the cases, you'll be given the account receivables, and other receivables. If you're not given other receivables, the examiner will give you prepayments. Other receivables can also be known as what? Prepayments. So what we consider here is the trade or the account receivables and other receivables. So in case you're given prepayment, also you have to consider that here. Are we together? Yes, because this is one of the items most of the students will not consider here. So prepayment, basically, I've said, is the same with other receivables. We are going to use the same formula. Opening minus closing, because the same with the receivables. So can you do that? Opening minus closing. Opening minus closing, what are you getting? That is giving us negative, Negative 600, Negative 600. Yes, I'm waiting for the answer. I'm not getting the answer fair. Please give me the answer. I'm saying under the current asset, we have below cash, we have prepayments. Below cash, we have prepayments. We have prepayments. It is positive, Yeah, it is positive. Okay. So then we got where we have current liability.